All right. Hello, everybody. Welcome back to the channel. We are here for Jerome Powell's final Fed chair meeting.
Yeah.
As a member of the FOMC committee, as the chair, he might still stay on as a Fed governor, but this is his last meeting as the chair. We got big tech earnings after this meeting. The meeting's going to be starting in about 14 minutes. We already got the decision. The decision was not to be surprising to anybody, but a unchanged rate. And we'll have big tech in just a little bit. Tanner, did you have any reaction to this? Or this was kind of basically what the market expected, and that's what we got?
Yeah, I don't think there was anything too surprising. No rate cut change was what the future said 100% was going to be the chance. And then Stephen Moran dissented, predicting a rate cut or wanting a rate cut. Is that surprising to anyone? I don't think so.
It was literally 100%. Is literally 100% on the probability. There wasn't even like a 0.0 something chance. So, that is what we got. The market doesn't really. I mean, it's down on the decision. I don't think it cares that much, but it's basically flat. So, I mean, obviously, it is what it is. Some big fintech names like Hood and SoFi getting hit today. Your Blooms, your Seagates ramping up. The real question is going to be, no matter what Powell says, what is the market going to be interpreting for the big tech earnings? And that's, I think, going to be a very important story after the bell. The other big thing about this Fed meeting thing is that it was an 8-4 decision, largest dissent since 1992, which is also, I think, very bullish, because basically the fact that you had 4 people say, no, we don't think we should be holding steady here, kind of means that there is a push to at least try to get a little bit more of a cut.
Yeah, well, they were dissenting on the easing bias, right? In the commentary in the statement. So I don't think it was that, like, although it was a big dissent.
You're saying three people wanted to hike?
Not that they wanted to hike. They were just not happy with the commentary in the statement. They said there was a easing bias towards the statement. They did not like that. So it was more on a hike side.
Oh, that's actually why we're okay. So that's actually more hawkish than bullish. So Moran wanted to cut, the others wanted to stay, and the other 3 probably didn't want to cut or hike, but they definitely didn't want to make it seem like it would be easy.
Exactly. That's my understanding.
Bitcoin's getting nuked right now. Well, obviously Bitcoin's getting nuked because PayPal's also up. Bitcoin's getting nuked because if the Fed is more likely to hike, or not hike, but just not likely to ease, then yeah, that's why Bitcoin, which needs liquidity, not the Clarity Act, it needs liquidity to actually go up. That's why that's getting hit. PayPal, I don't know why that's getting a candle. Are they getting bought out?
I don't know.
Such a weird day, bro. PayPal's going up 5, Bitcoin's going down 3, SoFi and Hood acting like PayPal from 2024.
In what world, in the fintech world, does PayPal go up 4 and Robinhood and SoFi are down 13% or something?
Wow. PayPal is separating Venmo into a standalone business under the new CEO, a move that can make the app easier to track or potentially sell. The reorganization comes as takeover interest has circled PayPal, with Venmo seen as its most valuable asset.
Yeah. And a spinoff like Venmo, I actually think would see a lot of interest.
I don't hate that. They could sell Venmo for what, tens of billions? Roundabout? I think they could. I mean, I know the company is only worth 40 billion, but
yeah. And then what is PayPal worth without Venmo?
Oh, that's a good question. Yeah, I wouldn't buy into the strength right there on PayPal. You got to get a lot more clarity, but that's the knee-jerk reaction right there. Getting some momentum. Trump suggests Ukraine war could end before Iran war. Why not? Trump will be releasing as much as we can on UFOs in the near future. Cactus, where is he talking right now? There's a lot of stuff that he's saying. Traders now see as much as a 25% chance of a Fed rate hike by April 2027, up from 20% before the Fed decision. That's another reason why Bitcoin's down, guys. I'm actually surprised the S&P is not down 2 to 3% today. With oil at 107, are you kidding me? Like, we talked about this in the morning. I thought it might calm down a little bit. It's not. It's getting worse. And Trump saying the Ukraine war could end before the Iran war doesn't help to get oil to relax a little bit. Now you have a 25% chance of a Fed rate hike by April 2027. Like, how the hell is the market actually somewhat green today.
Yeah, it's really surprising. Like, my biggest concern, and I was talking about this earlier, is we're talking about how short this war is, potentially a couple weeks, but I'm sure that was similar commentary of what we saw in Iraq, Afghanistan, Vietnam, and then those balloon into very large wars. But I'm sure Vietnam was not expected to be a 7-year war or whatever the actual duration was. They sort of balloon into that. I hope that that's not what Iran turns out to be.
Yeah, I would hope not either. Trump is live, Oval Office. Let's go to that for a couple of minutes before we got Powell in about 5.
Ceasefire, and we know exactly where it is, so it'll be knocked out within the first 15 minutes.
You're about to Mr. President. Thank you very much, Mr. President. I want to go back to the Supreme Court ruling on their Voting Rights Act. I know you said you haven't seen it.
When did it come out? Just now?
No.
I want to read it. What about it?
Early voting begins Saturday there, for instance. Should they redraw the map
He's with the Artemis 2 astronauts right now.
in the next couple
Well,
of
I would. I mean, it depends. I mean, some states don't need to redraw, and some do. I mean, I know what the concept of the rule. I just haven't.
2 hours to pass today, and there's still some tension over the farm bill. Do you think that you need to get more involved legislatively on Capitol
Well,
Hill?
we want the farm bill. The Democrats don't. We want security. Okay, we need security. We want security.
Okay, we'll try to get the clips of him talking about Iran, but yeah, to make this day even more eventful, you got Trump now live right before J-Pow's about to go live, and then you got big tech. I mean, what are people feeling today? Put it in the chat. It's obviously been wild. Tanner, I mean, just how have you been looking at all this price action throughout the entire day?
Well, you know, I was focused on some of the fintech names whenever SoFi reported earnings, and the chance of a rate hike is killing a lot of fintech, especially SoFi. Polymarket's now reducing the chance that the Fed might hike rates in 2026, now down to a 44% chance.
Wow. Good.
If I was a betting man, I'd say there is going to be a rate cut in 2026, but it's not looking like these are this is in my favor. That being said, the market continues to bet everything on artificial intelligence, and I'm looking forward to exciting earnings from big tech. But, you know, if Microsoft Azure ends up missing on those numbers, or AWS, or, you know, Meta comes out with worse than expected growth in advertising, it could be a not so great day for earnings once again.
Semi-Analysis came out with a report this morning. They said we expect CapEx to meaningfully accelerate across the hyperscalers, but they're going to tie it with increases in guidance on cloud. So hopefully if the CapEx does go up, which Mizuho says Amazon's going to be at 250, up from 200 billion, which would be a meaningful amount, the CapEx translates into revenue growth. So yeah, I agree. AI is still the story, but it is, guys, it is quite incredible to see Intel, which I know it's the darling of Wall Street right now, but Intel's going up 11% when oil is spiking at 107. Really? Like Bloom Energy up 20% when oil is spiking. Again, the earnings were amazing, but high beta does not really survive easily when the macro gets hit like this. And maybe it's a bullish sign that the market is able to ignore on a lot of these individual AI names, the price of oil going up. But how long could that actually last? I guess.
Yeah, meaningful CapEx acceleration is going to mean a lot for some of the more broader semi names. Like, you know, it's an easy bet on TSM, NVIDIA, AMD, potentially Intel, Micron. Some of those I just think are going to be such clear winners if we do see CapEx spend increase across the board today.
Qs are green. In the midst of all of this, Qs are green, which is either speaks to the resilience of the bull market or it's a rug pull. It's one or the other. And right now, maybe it's more resiliency, but we'll see what happens when J-Pow goes live and what he has to say. Micron as well, holding on to 1.93. This is down from 530. Amazon did hit all-time highs today. Same thing with Google. Nebby is getting a pump. This thing was almost below 130 in the morning. Now back at 141. So you're seeing some of these names come back. Again, PayPal potentially spinning up Venmo. That's why that stock pumped, and now it's not really pumping as much. But that was your core Your core piece of logic right there. Why are you laughing?
Jose texted me. He's just saw that I was live after I told him that I was not going live, but then supposedly he corrected you on the Meta earnings time.
Yeah, he did. I was like, oh, Tanner's doing Google. He's like, but Google is before. I was like, what do you mean? Then he texted, so he got the band back together. It's literally.
But they usually do. You're not crazy. They usually do 4:30.
Exactly, right? That's
Yeah.
That's
But today it's we're going to be able to do back-to-back earnings. So Google at 4:30 to 5:30, Meta 5:30 to 6:30 Eastern Standard Time.
This is the last Powell meeting ever as a Fed chair. Just some commentary. 2020, Jay Powell's Fed took rates down to 0.25. Inflation went up a lot, the highest in 40 years. Then he rose rates the highest in 20 years to 5.5. Now we're at 3.5. Do you think he's been an overall good Fed chair, Tanner?
I think people give Jerome more flack than he deserves. They've not been perfect. If you had to give him a report card, I think he did all right. Like a B plus or an A minus. I should have said A minus. God, I missed such a good joke there.
That would have been a good opportunity.
Oh man.
Yeah. I mean, look, I think Powell made some mistakes, but it's also not fully his fault that Congress printed $10 trillion to combat COVID, right? Like, I don't think he unilaterally, like a lot of quantitative easing, sure, but Biden and Trump both printed a lot of money in stimulus. And so that's kind of the situation that he was wrapped up with in terms of the money supply going up. By the way, Pershing Square has come up in terms of its IPO. 50 was the price. It's at 41.75. Put in the chat if you bought this IPO. Again, I'm a little skeptical of it in general, but obviously not a successful IPO at the open. If there was a $50 listing price, that means they could not get enough demand to keep it above 50. And now it's going to be up to Ackman to get people to continue buying into Pershing Square here. Here is Trump on Putin just a couple of minutes ago.
You spoke to Vladimir Putin not too long ago. Did you talk to him about
today?
Did you talk to him about the progress in the space area? And what else did you?
I didn't talk about space. No, I talked about Ukraine, and I talked a little bit about Iran. I talked about a few different subjects, mostly about Ukraine, and we had a very good conversation. I think we're going to come up with a solution relatively quickly. I hope.
What does he want
I
to do?
think you'd like to see a solution. I can tell you, and that's good.
What involvement does he?
All right, that's what you got from Trump. Jay Powell is going to be live any second. Someone says, do you think Powell's going to use this meeting to stick it to DJT? I don't think he's going to try to be political. I mean, this is the last meeting, so I mean, what does he have to lose, right? No matter what he says up or down, in terms of like being negative or positive towards Trump. But
Yeah, he usually is pretty neutral.
Apolitical. Yeah, I don't know. I think they're going to try to ask him, hey, are you leaving or staying as a Fed governor? He's not going to answer that question either. So yeah, I don't think there's much we're going to get from him there. Trump on UAE pulling out of OPEC. I think it's great. Okay. Yeah. Put in the chat. Do you think he's going to have a purple tie?
Yes.
This is the last one. I think he will. I imagine Kalshi is getting loaded up with bets.
Can you imagine he wears a blue tie like the last one?
No, the problem is blue is Democrat, red is Republican. So that's like,
Yeah, it would be like an anti-Trump comment.
oh, that
It'll
is
be
funny.
purple.
Trump says it's a good time to lower rates. That is interesting. So 4 Fed members dissented. 1 of them wanted to cut. 3 of them basically are upset with the statement the Fed put out that was more towards the bias of easing. The Fed also said inflation is back, by the way. Development in the Middle East creates more of a high level of uncertainty. And I imagine Powell will cite the war continuing as not the best thing for inflation either.
Someone said he should wear no tie, and I agree. He should go a little bit like a retirement Powell and just pop the collar.
Yeah, literally pop the collar and just.
No, I'm really excited to hear what the commentary is. I just hope that they still talk about the current state and not just talk about what he's going to do after, if he's going to stay around. I care about that much less than what I care about the current state of the Federal Reserve and how they think about the dual mandate.
Yeah, and once again, for everybody, usually what he says really matters on a day like this. 2 reasons it doesn't today. He's out after this, so the market's going to look past what he says because Kevin Warsh is going to have a different perspective, most likely. Number 2, you've got the biggest companies in the world reporting after he speaks, and we'll see what he says after that. There we go.
For press conference as Fed chair.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months. Inflation has moved up and is elevated, in part reflecting the recent increase in global energy prices. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. Developments in the Middle East are contributing to a high level of uncertainty about the economic outlook, and we will remain attentive to risks to both sides of our dual mandate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand at a brisk pace. In contrast, activity in the housing sector has remained weak. In the labor market, the unemployment rate was 4.3% in March and has changed little in recent months. Job gains have remained low. A good part of the slowing in the pace of the job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. Inflation has moved up recently and is elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 3.5% over the 12 months ending in March, boosted by the significant rise in global oil prices that has resulted from the conflict in the Middle East. Excluding the volatile food and energy categories, core PCE prices rose 3.2% over the 12 months ending in March. This relatively high rate largely reflects the effects of tariffs on prices in the goods sector. Near-term measures of inflation expectations have risen this year, likely because of the substantial rise in oil prices. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. The economic outlook remains highly uncertain, and the conflict in the Middle East has added to this uncertainty. In the near term, higher energy prices will push up overall inflation. Beyond that, the scope and duration of potential effects on the economy remain unclear, as does the future course of the conflict itself. We will continue to monitor the risks to both sides of our dual mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. This is my last press conference as chair, and I will close with a few thoughts. First, I want to congratulate Kevin Warsh on his advancement out of the Senate Banking Committee this morning. This is an important step forward, and I wish him well as that process continues. The Federal Reserve exists for one fundamental purpose: to foster the economic conditions in which American families and businesses can thrive. Stable prices, a strong job market, and a financial system they can depend on. Every decision we make, whether about interest rates or regulatory and supervisory matters or other issues, is made in service of that purpose. Our decisions reflect the collective judgment of the Board of Governors and the Federal Open Market Committee, colleagues who demonstrate analytical rigor, principled judgment, and a genuine commitment to the public interest. Our collaborative and deliberative process has long reflected a shared commitment to finding common ground in service to our mission. This institution is resilient, capable, and staffed by professionals of extraordinary talent and exceptional dedication. It has been a privilege to serve alongside so many great public servants at the Board of Governors and around the Federal Reserve System. The Fed's work is only as effective as the public's understanding of it, and you, the press, are essential to keeping the public informed about what we do and why. The people we serve benefit from your careful reporting. I welcomed the announcement last Friday by the U.S. Attorney for the District of Columbia that she had closed the criminal investigation. She also noted, however, that she would not hesitate to restart the investigation. Over the weekend, the Department of Justice provided assurances that they will not reopen the investigation unless there's a criminal referral from the Fed's Inspector General. And, absent such a referral, if they do appeal the recent court decision, they would not seek, as part of that appeal, to restart the investigation or send new subpoenas. I've said that I will not leave the board until this investigation is well and truly over with transparency and finality, and I stand by that. I'm encouraged by recent developments, and I'm watching the remaining steps in this process carefully. My decisions on these matters will continue to be guided entirely by what I believe is in the best interest of the institution and the people we serve. After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. There's only ever one chair of the Federal Reserve Board. When Kevin Warsh is confirmed and sworn in, he will be that chair. Once sworn in as board chair, his new colleagues will elect him to chair the FOMC as well. As I regularly point out from this podium, our success in delivering our goals matters for all Americans. I'm confident that the Fed will continue to do its work with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you, Mr. Chair. Appreciate the kind words about the press. Often doesn't come from the podium in different places, but appreciate that. Can you talk about what is gone into your decision to remain on the board? What kind of criteria are you weighing, and how long might you stay? Thank you.
Sure. So, my concern is really about the series of legal attacks on the Fed, which threaten our ability to conduct monetary policy without considering political factors. And I want to note here, this has nothing whatever to do with verbal criticism by elected officials. I've never suggested that such verbal criticism is a problem, and neither has anyone else here. But these legal actions by the administration are unprecedented in our 113-year history, and there are ongoing threats of additional such actions. I worry that these attacks are battering the institution and putting at risk the thing that really matters to the public, which is the ability to conduct monetary policy without taking into consideration political factors. It is so important for our economy, for the people that we serve, that they can depend over time on a central bank that operates that way, free of political influence. It's part of the absolute foundation of this amazing economy that we have. It's just one of the many reasons why the U.S. economy is the envy of the world. That piece of institutional architecture separates successful countries from unsuccessful countries. It is extremely important, not for the people who work at the Fed at any given time, but for the people that we serve, that the Fed remain able to conduct monetary policy in a way that doesn't get pulled into politics, trying to help or hurt any particular politician or political party. It's critical for the people that we serve. In terms of when I would leave, I will leave when I think it's appropriate to do so. Was that all your questions, or was that?
Well, I just have a follow-up, which is, what would you say to the criticism that by remaining on the board, you're actually taking a political act and denying President Trump the majority of the board, which as president he would have if you left?
I don't see that at all. And as I mentioned, I'm literally staying because of the actions that have been taken. I had long planned to be retiring, and the things that have happened in the last 3 months have I think left me no choice but to stay until I see them through at least that long. In addition, I don't see how this will interfere. My intention is not to interfere. I was a governor for almost 6 years, and the tradition is at the Fed that governors who understand how difficult the role of chair is. And as a soon-to-be former chair, I do understand how hard it is to get consensus with 19 strong-minded people. You work with the chair. You try to be heard, but also collaborate with the chair and try to support the chair when you can. When you can't, you can't. And I think that's the attitude that people generally take, and that's the attitude that I'll take.
Nick.
Chair Powell, if I could ask about the inflation outlook. In March, you described the standard practice of looking through energy shocks as conditional on inflation expectations staying anchored. Since that meeting, there has been very little progress reopening key energy trade corridors. Can you help us understand how the inflation outlook has changed in the intermeeting period, beginning with the prospects for tariff pass-through resolving on the timeline that you had outlined in March, before getting to the energy shock that is now on top?
So, I would look at it this way. For a long time, we've been working on the hypothesis, really, that tariffs would lead to a one-time price increase and that would go away over time. In other words, that there would be no further change. So measured inflation wouldn't reflect that higher level going up more and more. And it's time for that to happen. We really do expect that to be happening in the next 2 quarters. So we'll be watching very carefully to see that what we've thought all along would happen. That's the kind of critical part of the forecast. We need to really see that. With energy, it's so hard to say. I mentioned, in sort of the textbook, you would look through an oil shock because they tend to be short-lived and they tend to revert. And monetary policy works with long and variable lags, so you wouldn't necessarily react right away. I think that is all the more true given that we're several years above 2% inflation and that we're already looking through the tariff shock. So I think we're going to be very cautious about that. But the question about looking through energy really is not in front of us right now. It hasn't even peaked yet. And I think we'd want to see the backside of that and progress on tariffs before we even thought about reducing rates.
So if I could follow up, the statement today preserves language that has taken on some meaning as it was socialized when the committee was actively lowering rates. Why is that easing bias still ripe, given how different the inflation outlook is now versus a meeting or two ago? And what more would have to happen for it to get evicted?
So that was, as you will recall, we had a discussion about that at the last meeting, and we talked about it in the press conference after the March meeting. We had the same today. We had quite a vigorous discussion about that very issue and the guidance, and is it still appropriate and that kind of thing. And I would say that the number of people on the committee who either could support that language changing to a more neutral stance so that a hike is as likely as a cut. That number has increased over the intermeeting period, and it's easy to see why. I mean, it's a good question, right? You see, inflation has moved up over the interim a bit. Core inflation is 3.2 now, moving, albeit just a little bit, in the wrong direction. And we know that there will be, that there's headline inflation coming out of the Gulf, and we don't know how much that will be. We're going to need to see. So it makes all the sense in the world that people would look at that and we'd have a vigorous discussion about that. You saw that 3 people dissented over the language. I think all of those people agreed with the rate decision. So the majority of the committee did not want to do that, and I didn't think we needed to do it at this meeting. It really was just a question of why do we need to do that now? We have so much to learn. There's so much uncertainty about the path ahead. There doesn't need to be any rush to make that decision now, because what happens in the next 30, 60 days, even by the next meeting, could really change the picture around that language. So, it's a much closer thing on the committee than it was in March, and that makes all the sense in the world, it seems to me.
Claire.
So Claire Jones, Financial Times. Just going back to this issue of the easing bias. We've now got oil approaching $120 a barrel when it comes to the benchmark Brent crude. If it stays around those levels 6 weeks from now, what would be your best guess as to whether the easing bias will still be in the statement? Thank you.
I wouldn't want to guess. Well, first of all, we're going to have new leadership in all likelihood by then, and new leadership is going to have a very important role to play in that. So I won't be standing here at this podium to answer your question. So I don't know. As I mentioned, that's all I can really say is that we had a great discussion about that today. It's gotten to be a better question in the interim period. We had the discussion. A majority are still on the page of not feeling the need to move to that level, and I that's where I am. I get it though. At a certain point you would move, and that conceivably could come as soon as the next meeting.
Thank you. Just to follow on, the new leadership also seemed rather lukewarm on press conferences and on the dot plots. What would your advice to him be on these communication tools?
So I'm not going to give him any advice through you today here, but I think communications generally is. I think every incoming chair takes a look at communications, and it's a very healthy thing. I mean, communications it's very complex, and you can always be looking at new things. And if that happens, feels like it's going to happen, that's a completely appropriate thing.
Neil.
Hi, Chair Powell, Neil Owen with Axios. Can you tell us if you've been in touch with incoming Chairman Warsh? To what extent is this a normal transition process versus all the things swirling around, something unusual, and what can we expect when he takes that podium in a few weeks?
I haven't seen him since seeing him at a dinner in January where I congratulated him and had a nice chat with him. Haven't seen him. I don't know what a normal process is. The last process was with Janet Yellen, with whom I had worked for 6 years, and so it was. We were sitting down the hall from each other, so it was a very different thing. I think this is and will be a very normal, standard kind of a transition process. So that's what I expect. I have every reason to think it will be.
Quick follow-up: is the Supreme Court ruling on Governor Cook a factor in when you may leave as a governor?
I wasn't thinking of it as such, but no, not really. I mean, I'm thinking more of the other things I mentioned.
Hi, thanks for taking our question. I wanted to ask a question about your tenure, and Chris Rugaber at Associated Press. During your tenure as chair, you often spoke about how disadvantaged Americans benefited from extended periods of low unemployment. In the new framework the Fed adopted in 2020, some economists say elevated the Fed's employment mandate. Are you worried that the pandemic inflation spike that followed will make future Fed chairs more reluctant to pursue a hot jobs market? And should they be?
I don't know the answer to that. I mean, what we experienced in the teens, the mid-teens, was really low levels of unemployment for a long period of time and no reaction from inflation. And we all very much took notice of that. We also noticed that the biggest wage gains were going to people at the bottom end of the income spectrum. And we had many reports of, it felt like a fairly stable equilibrium, and a lot of benefits were flowing to people at the bottom end of the income spectrum, including companies were, setting up in people who were confined and like training them before they got out. And it was a very healthy sort of set of societal dynamics. So of course, I think anybody would love to get back to that. I don't think that anything that happened to create the global pandemic inflation was in any way related to overweighting the employment market. I mean, it was a global shock that happened essentially very similarly all over the world. That had to do with closing, reopening, stimulus, and all that. And I mean, you could look at a graph of 10 big economies on the page and not know which was the U.S. and which was Germany, France, and things like that. So I don't think that insight was in any way responsible for the high inflation that we experienced. So, I mean, I think it's always been a balance. You've got to be strong on both of our dual mandates, and we for example, now we don't feel that the labor market is at all a source of inflation, so we don't need to be worrying about that. It's been a long time since we have had to worry about that. Well, actually, during the pandemic recovery, the labor market was super overheated and tight, and that's when we had to worry about it, but not now.
And just on the other issue, do you need more assurance from the Justice Department before stepping down? Is that what you're waiting for, or What else?
I'm
is gonna
waiting,
affect your
for the investigation to be well and truly over with finality and transparency. And I'm waiting for that. And I will leave when I think it's appropriate to do so.
Michael McKee.
Michael McKee from Bloomberg Television and Radio. I'd like to ask you if you could explain a little more or characterize a little more the discussion about the two-sided view and interest rates, because there were some members of the Open Market Committee who've been suggesting that we may need to raise interest rates even absent the war because inflation was not coming down fast enough. Is there any sense that interest rates might have to go up, or was this just a setup to sort of warn people that you're worried about the war impacts?
So nobody, the three dissenters and others who could have supported that, and others who were, who were voters and non-voters who preferred it, they all supported the rate decision, right? So people are not saying we need to hike now. It's more a question of, don't we kind of feel that we should be neutral? And what are markets doing? People argue that this is consistent with markets are doing. And again, it's a very fair question, but these changes, there is, it's a form of forward guidance, and you want to make them in a way that will be sustained and continue to make sense, and not something you need to take back, fairly quickly. So I think we just, a group of us, including me, didn't feel like we needed to be in a hurry on that markets are not confused about our reaction function. We don't have a problem to solve on that. But the other side of the argument is a good argument too, as I mentioned. It's a perfectly good argument to be having, good discussion to be having. So, and it came out the way it came out.
Well, you've got three dissents in favor of two-sided warning. You've got yourself staying on the board. You've got the criticism that does come from elected officials, and you've got a lot of critics who have faulted the Fed for being too slow 2021 with inflation. Are you worried about Fed credibility under all of this? Is that one reason that you want to stay on?
Not driving my thinking now. I mean, monetary policy is going to get made by, 19 people. There's a lot of stability there. I mean, if you think about it, every new Fed chair has the same situation, which is you've got 18 colleagues on the FOMC, 11 of them vote during any year, and your job is to create consensus. It's to talk to them, understand them, be inside their thinking, and be able to pull them together and get consensus and move. And that's what every Fed chair has to do. And I think Kevin Warsh is actually quite well. He has the capabilities, skills to be very good at that, I would think. So I think I'm not so worried about that process. I think that'll work itself out.
Thank you, Chair Howard Schneider with Reuters. You mentioned that staying on as a governor, you intend to keep a low profile. I'm just wondering if you could give us a little more detail on what that looks like and how you can, touche. Walk down the steps. What that looks like, and particularly around the policy discussion, how you're able to have your intervention and not be a shadow chair and not have a kind of an outsized influence over the process.
Yeah, that's just something I would never do. The shadow chair thing. No, I don't know what the exact specifics of it will be, but I'm going back to being a governor. I respect the role of chair. I was a chair. I was a governor for 6 years, and I know what that's like. I know it, and I had a pretty front row seat particularly with Chair Yellen, to whom I was close when I worked with Chairman Bernanke for 2 years, but I was brand new at that time, so I got a sense of what it was, and I had real sympathy for how hard it is to get that group to consensus. And I always felt like I don't want to add to that unnecessarily, and that means try to support the chairs where the direction the chair wants to go in, if you can. If you can't, you can't. And I think that's the way it's always worked there, because the chair only has one vote, plus the ability to develop consensus. And if people won't be, they won't, if they're not flexible at all, then how do you ever do that? And so that's why the authority the chair has really is to develop relationships with people and work with them, and then put something forward that has consensus. And I propose to be a very constructive participant in that process, really out of respect for the office of the chair.
And in your view as a soon-to-be governor, how do you see the risks of oil prices bleeding into core inflation in coming weeks? Because that was, it seems like the commentary that was coming from particularly some of the Reserve Bank presidents, they were elevated concerns about the bleed into core. And, here we are with 3 dissents now. What do you see as the prospect of a core inflation?
Those prospects are real. Remember, though, and the real thing is we're going to have to wait and see. We're going to need to see. And the good news is we think our policy stance is in a very good place for us to wait and see. We're right kind of at the high end of neutral or perhaps mildly restrictive. The labor market shows more and more signs of stability, whereas inflation is kind of misbehaving. And so maybe a little bit of restriction or the high end of neutral is just the right place to be. So we can wait here and see how things work out before we act. And we'll see how much how much does come through into core. You see it already in airfares, of course, but you may see it in many other places. We just don't know yet. And it's so unknowable because how long will the strait be closed? You can develop any number of scenarios that you want, but we really won't know till we know. So fortunately, we're in a good place to wait and let things develop.
Thanks, Mr. Chairman. You started holding post-meeting press conferences for every meeting as opposed to the ones with just with SEPs. Can you talk about why you see that as a net positive?
So we always said when we were doing quarterly press conferences, we always said we can move at any meeting, but we only ever moved at the quarterly SEP meetings where we had the press conference. So if you think about it, during the pandemic, we were moving like a lot at every meeting and sometimes between meetings. And doing that without a press conference, I think would have been quite challenging. It's become the industry norm. It's the standard. I don't know whether that has to remain that way. I don't know. I mean, it's just something people have become used to. And I do think it's quite helpful to I try to deliver a message on behalf of the committee rather than 18 other people going out and delivering their message. And it's going to be all over the place because we do thankfully have widely disparate views.
Okay, thanks. The other thing I wanted to ask about was the communications review from last year. Could you describe the debate last year, what changes were considered, what you wanted, and what prevented action, any action on those changes?
So I'm not going to go into the real small specifics, but what we found very quickly was that making changes, making really large changes, for example, to the dot plot or the SEP, it didn't have, we couldn't come up with anything that had really broad support on the committee. And so we just didn't really do as much on that as we might have. And, I was never the world's biggest fan of the dot plot, but you can't beat something with nothing. And, we've looked at a bunch of things and, it's something like I said, I think every new chair is going to look at our suite of communications and think about what would be changes. We are the only major central bank that doesn't publish a forecast. And that's because we have a 19-person committee and, you try to do that at the board, that's hard. At the committee, that's hard. It's hard if you do it at the staff. So it works. I think our communications are fine, but looking at doing it in a different and better way is the most natural thing in the world.
Thank you. Colby Smith with the New York Times. If I could follow up on Mike's question about hikes, are we right to assume that the hawkish outcome for the Fed is still one in which the committee just extends the pause in rate cuts? And to what extent is there a growing sense within the committee that monetary policy really isn't just restrictive at all right now? The economy is holding up relatively well despite this major energy shock. The unemployment rate has ticked lower. Inflation was moving sideways even before the war and is now moving higher. So where is the committee at on that debate?
Where we're at is we think our policy rate is in a good place. If we need to hike, we will certainly signal that, and we will certainly do it. And if we need to cut, then if it's appropriate to cut, then we'll signal the opposite. I think because we feel like we're in a good place to move in either direction. Nobody's calling for a hike right now. So it really is going to depend on how things evolve. And, you know, that's really where it is. And as I mentioned, much closer question this cycle on changing the guidance, but ultimately we didn't.
And as it relates to the war, at what point do you think the risk to growth will be larger than the risk to inflation as this conflict drags on?
You know, you just have to find that out empirically. You know, given our the fact that we're, you know, a big exporter of energy and that our economy is far less energy intensive, oil intensive than it was during the 70s, you know, the effects on the United States are really substantially less than those of Western Europe or Asia, who are feeling much greater effects from these things. The effects we're feeling in the current situation currently, and in sort of what's priced in, which is you know, a relatively quick outcome. If this goes on for much longer and prices go much higher, then we'll feel that much more. And of course, I'm talking about aggregate inflation numbers. We're very well aware that people are experiencing higher gas prices all over the country now, and that hurts. And those hikes may continue to happen. And other things are going to start to reflect airline fares I mentioned, and other products and services that are dependent upon petroleum and derivatives of petroleum. People are going to start to feel that.
Edward.
Thank you, Chair Powell. Edward Lawrence with Fox Business. So I guess I'll just ask you directly on this. The markets don't see a rate cut at all this year, is what they're predicting. Do you think that we are at the neutral rate? Why or why not?
You know, the neutral rate is we cannot know it with certainty. I think pretty close to the neutral rate. Yeah, I always had it, you know, between 3% and 4%. We're a little north of 3.5%. So that's well in the range of what I would consider a reasonable, but at the higher end of the range of what I would consider reasonable neutral rate. You know, I think the labor market is still probably cooling off just a little bit. And I don't think there's much of a case for any case really for policy looking, you know, meaningfully restrictive, maybe mildly restrictive or neutral, I would say.
And I want to follow up on some of the other questions about your future a little bit. The first time we've seen 4 dissents now since October of 1992. Are you handing off a divided Fed?
You know, the thing to remember is we have always had vigorous debates, and they're excellent debates. I have to say they've been really good, and we're in an unusually difficult situation. So we've really had 4 supply shocks. You can say more than 4, but at a minimum, we had the pandemic, we had the invasion of Ukraine, we had tariffs, and now we have Iran and the oil, you know, the oil spike. So every supply shock has the capability of driving inflation up and unemployment up. And what do? You know, the central bank has a really hard time knowing what to do. So the right thing to do is to try to balance the achievement of those 2 goals, and that's what our framework calls for us to do. But these are really tough, difficult judgments. You've got to have a forecast for each variable. You've got to think how long it's going to take to get back to target. You got to think how restrictive or not is policy. So it's only natural that you have a range of views on the committee. You know, people are going to see it different ways. They're going to have different risk tolerances and that kind of thing. I mean, if everybody agreed, that would be surprising. And I think it's partly a function of the extraordinarily challenging set of supply shocks that we've been dealing with now for 5-6 years.
Thank you so much, Chair Powell. Selena Wang with ABC News. Are you confident that Kevin Warsh will stand up to political pressure from President Trump?
So he testified very strongly to that effect in his hearing, and I'll take him at his word.
And when it comes to gas, right now it's over $4 a gallon. Inflation just hit a 2-year high. Should Americans expect to be paying higher gas prices for the rest of this year? And in your view, does that take a rate cut off of the table? And secondly, by staying on as Fed governor, what message do you think you're sending to the president?
I don't know what gas prices are going to do for the rest of the year. And It will depend on how long the strait remains closed and how quickly it can be reopened and that kind of thing. But remember, when gas prices go up, that's disposable income coming out of people's pockets. So they're going to spend less on other things. So there will be a hit to GDP. So it's a, it's a question whether spending, goes down to offset the inflationary effects. So it's not, the answer isn't obvious ex ante whether you should move your rate over because of that. We'll have to see how it evolves.
By staying on.
I'll stand on what I said earlier.
Victoria.
Hi, Victoria Guido with Politico. During your tenure, Fed independence has come under pressure in a lot of different ways. And I was just wondering, practically speaking, where do you see Fed independence as coming from? Is it the law? Is it political support from Congress? Is it the actions of the Fed? What sustains Fed independence?
Well, it's to a significant extent, it is the law. And, we've had to go to court to successfully so far to defend it. But, the law does create a setting in which the Fed can and is directed to make monetary policy without consideration of political factors. And so part of it is the law, but it goes beyond that, though. There's a set of customs. There's a boundary line between the Fed and the administration, between the Fed and the Treasury Department. And we need to continue to respect those boundaries about what the Fed is responsible for and what the Treasury is responsible for and what the rest of the administration is responsible for. So some of it is legal. In fact, it's all legal at the end of the day, but it's more than just monetary policy. We don't want to use our tools we haven't wanted to use our tools to achieve goals that are really clearly outside our mandate. Every administration looks at our tools and thinks that would be good to repurpose those to serve other purposes, but that's dragging us into politics and into fiscal policy. So we've resisted that.
Well, and maybe another way of asking it too is, do you think that Fed independence is as strong now as when you became chair? And if so, why?
Look, I think it's at risk. I mean, I think these legal assaults, if you will, as I mentioned, the institution is being battered over these things. We're having to resort to, the courts to enforce our legal, it's not so much independence. It's really the ability to make monetary policy without political considerations. That's what we're talking about. And we've had to do that, and we've been successful so far, but that's not over. None of that is concluded yet. And it's really important. It's not about people who work at the Fed or the institution. It's about the benefits of a central bank that makes decisions based on analysis and our best thinking, rather than trying to help or hurt politicians. It's that there's a bright line between central banks who do one and do the other, and successful countries have uniformly, successful advanced economy countries have a really strong set of protections around their central bank just for that reason. So that's what it's all about. I think I am confident, as I said in my remarks, that the Fed will continue to make its decision based on analysis, rigorous analysis, and not on political considerations. But we've had to fight for it. And I'd like to think that, we can get out of that era and go back to respecting, what the law says and what custom has been, which is to, let the Fed do our thing. It's an institution full of human beings who work super hard to get things right for the benefit of the public. We're all human, don't expect for perfection, but do expect us to make, decisions without political considerations and the very best analysis we can bring.
Katerina Saraiva, Bloomberg News. How would you characterize what you've heard from your colleagues on your decision to stay? Do you have their support? And then have you heard concern from your colleagues about continued legal attacks from the executive branch? Is this something that others have, talked to you about?
So I think that I don't want to report on what my colleagues think. They can speak for themselves. But there are there are widespread concerns that these things may continue. That's all I'll say. And, and that would be a problem. And so.
And then I just also wanted to ask about Governor Waller's speech on the reserve banks. What, do you have any thoughts on centralizing some of those functions in the way he described? And then are you concerned that something like that could potentially be a slippery slope to consolidate reserve bank functions even more in such a way where the central bank ultimately loses some of that important regional information?
So we try to be good stewards of the public's money and efficient. And Chris Waller is particularly passionate about that. Of course, so are the presidents. And, it's a question of how do you accomplish it? We of course, and Chris said this in his speech, we want 12 strong independent central banks with their own staffs and their own monetary policy views and all that. But, there are things that are done in all 12, which could well be done at one much more efficiently and with cost savings. And so there's a back and forth going on that, but everybody's on the same page. The other thing he touched on was the idea of removing reserve bank presidents from office over different views on monetary policy. And I would just agree with him so strongly that would be the beginning of the end of the Fed's ability to make monetary policy independently. If every administration could come in and do that, you're just another cabinet agency at that point. So that's not something that I would support. Chris said the same thing.
Christine. Thanks, Chair Powell. Christine Romans, NBC News. I want to ask about legacy. When the history books are written, how do you think your stewardship at the Fed will be remembered for the past 8 years?
I'm going to just say that that's for someone else to say. I'll give you a mulligan on that.
All right. I'm going to ask you about misbehaving inflation then. You talked about those 4 big shocks, supply shocks over the past 5 years, and inflation still misbehaving. What's your message to American families who feel like inflation has not been under control for them really since the COVID reopening?
We're committed to bring inflation back down to 2% and sustainably. That's our goal, and we'll stick at it until that happens. We keep getting these events keep happening, which keep driving up costs. And, the best thing we can do is to use our tools to guide inflation back down to 2%. I think trying to get there really quickly could be very costly in terms of job loss and things like that. But we try to get there over time in a way that does the least damage possible. And, our commitment to that is never ending and unshakable.
How would you describe the economy outside of the misbehaving inflation? I mean, it's still awfully resilient given all of the blows.
I don't know that you can be awfully resilient. So it's actually quite resilient, I would say, because it's a positive thing if I can have that amendment. Yeah, the growth is really solid across our economy. Some of that is that consumer spending is hanging in pretty well. The most recent data are good. And some of it is just the apparently insatiable demand for data centers all over the United States. So a lot of business investment going into building data centers, and every reason to think that continues. So you've got an economy that's growing at 2% or better. PDFP, which is private domestic final purchases, which is really a better signal of a momentum in the economy, is actually higher than that. So that's a positive thing. If you look at the unemployment rate, it's 4.3%. So that's a low rate. That's pretty close to mainstream estimates of the natural rate. We've been there for a long time. So it doesn't feel like a good labor market to some who don't have jobs, because quits are really low, hires are really low, and there's effectively no new net job creation. So that's in a sense, the labor market is in balance. But it's an unusual and uncomfortable kind of a balance where people who don't have jobs will have a hard time breaking in unless somebody quits their job. So that's pretty good. Inflation is the thing we need to work on, and it's partly tariffs, which we think that inflation should subside over the course of this year, because it's kind of a one-time increase. It shouldn't be repeated, and that should start happening pretty soon. The energy inflation that we're getting should go through fairly quickly. And we'll just have to see how that works out. In the meantime, we think our policy stance is in a good place for us to hold and wait developments.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. At the risk of beating the dead horse here, clearly 3 members objected to keeping that easing bias in the statement. And you said that the majority still didn't need to move to new language at this point. So does the majority of the committee still have a bias towards cuts at this point, or has the bias on the committee shifted away from cuts towards holding or hikes if that was needed?
So I think that, the center is moving toward a more neutral place. And that's sort of what markets are saying too. I just think, there's a lot of signaling going on when you change guidance like that. And so we just, I guess a majority of us didn't feel like we needed to send a signal on that right now. But maybe it'll come to that. And the reason is because, we're kind of waiting to see what happens with events in the Middle East and what are the implications of those events for the US economy. So there's a group who feels like we don't need to be in a hurry to do that. We get it. And of course we will move to a hiking bias if we want to hike, and we'll move to a neutral bias before that. But there was a difference over whether to do it at this meeting, at a meeting at which all but one of us agreed that the rate decision was correct, which was not to move.
And you just said moments ago that you believe Fed independence is at risk. Is it safe to say that you want to stay on as a governor to serve as a check and balance on that?
I want to stay until I will stay until I feel it's appropriate for me to leave. And yes, that is really what is driving this. I'm not looking to be, a high profile dissident or anything like that. I'm more looking at the other aspects of this and wanting to see that things have calmed down and we're returning to a traditional model of working with the people that you have and bringing them to consensus and respecting that consensus. That's what I'm hoping to see.
Matt Egan.
Thanks, Chair Powell. Matt Egan, CNN. You've made many tough decisions in your time at the Fed. And as your time as chair comes to a close and you think about your tenure and perhaps your legacy, are there any decisions that stand out as ones that you're particularly proud of? And are there any that with the benefit of hindsight, you would take a mulligan on?
Yeah, it's hard. I wouldn't want to single out individual things at this point. I'll just say, all of us together have consistently tried to do what we think is best for the American people based on our tools and our objectives that Congress has given us. It's been very challenging because we've been in a situation of supply shocks really for 6 years. And that's just a very different situation than for a very long time. What the Fed and other central banks were doing all the time was demand management. And, and there was always the inflation mandate, but inflation was low for 25 years. So this is a very different world and a much more challenging one where you have to balance the two objectives. And by the way, central banks that have an inflation mandate have to do exactly the same thing because they're balancing economic activity. So that's been challenging. And we've tried to do our very best through these really challenging times. And I'm really proud of the work that I've done, that my colleagues and I have done during these years.
Now, to follow up on some of the discussion around Fed independence, can you explain to the public why this notion of Fed independence, which might sound kind of wonky to some, is so critical? I mean, what are the consequences if either the Supreme Court rules against Lisa Cook or the Fed in the future decides to make decisions more around the political calendar instead of the economic data?
So every major advanced economy in the world has made the same decision the United States has made, and that is that they want to take the making of monetary policy, the setting of interest rates to support the economy, to achieve maximum employment and price stability. They want to take that out of the direct control of elected politicians. And the reason is elected politicians are always running for election, and they'll always want low rates, and that will lead to inflation over time. So after literally centuries of experience with that. The whole world moved to the different model, and it's worked great. I mean, this is the era in which inflation was under control for 40 years. Then we had the pandemic, inflation everywhere in the world, and now we have inflation that had gone pretty much all the way back to target, really close to all the way back to target, and now is being buffeted by the energy shock, and the U.S. buffeted by the tariff shock as well. So, but what I would say to the general public is that's the backstory. Is that don't think about it, an institution being independent. Think about it this way: that you want people to make monetary policy and set interest rates to benefit the general public and to try to achieve economic goals, which are maximum employment and price stability, and focus only on that and ignore political considerations completely. Ignore them. This isn't bipartisan. This is nonpartisan. So we want to just work directly for the American people doing these things. We don't think, oh, I want to do this because the president says it's a good idea, or because there's an election coming up and I want to speed up or slow down the economy. I mean, think about that. If that's what we were doing, we'd have no credibility. Markets would lose faith in us, and our ability to control inflation and have any respect would be gone. And let me say, whatever people say, the markets believe in that we will produce 2% inflation. If you look at longer run expectations, markets believe that there's no sense in which our credibility in the markets has weakened. It's just not the case. It's people do get it, that this is our commitment and that we will achieve it, and it's priced in. If you disagree with that, then you can go ahead and bet against the markets, but the markets are pricing in Fed credibility.
Okay, we'll go to Richard for the last question.
Thank you, Chair Powell. Richard Escobedo with CBS News. We talked a lot about gasoline prices and even you mentioned airline ticket prices, both of which are up dramatically because of the war in Iran. And so I wonder, are you seeing that weigh down consumer spending in other parts of the economy? And if so, how worried are you that that will be a drag on growth?
You don't see it in spending yet. You really don't. I mean, as one of your colleagues said, the economy has been resilient. It really has. Not just this time, but it's been remarkably resilient for some years now. The U.S. economy has just powered through shock after shock, and consumers are still spending. And that's what the banks will tell you. Credit card companies will tell you. The retail sales numbers that we got most recently, people are still spending. And, how long can that go on in a world where if gas prices were to go up a bunch more, that's taking otherwise spendable money out of people's pockets. But right now, we don't actually see much slowdown yet, and certainly none from this. But you think logically you will, because people have a certain amount of money to spend. If they're spending 25% more on gas or something like that, then that's going to come out of other spending. But we don't see it yet.
One last thing. You mentioned those economies in Southeast Asia that are particularly dependent on petroleum. They make a lot of the stuff that American consumers buy. So was there any discussion today about whether or not those costs getting passed along to consumers is a real concern, and whether or not that might push up inflation?
So all of those things are in the models that we use to calculate inflation. So they're just parts. You can ask about anything like that, and they have a place. The staff has a place where they're looking at that and pricing in what will happen with higher prices and that kind of thing. So it's there. The effects are not that big yet. We're a huge economy. The import sector is only 10% of the economy. So we're not like a European country where 50% of the GDP is in the external sector. We're also, as I mentioned, we're an oil exporter. So we're not feeling the same kind of pain, and we're not likely to feel the same kind of pain that economies in Western Europe and certainly in Asia are feeling. Anyway, thank you very much, everyone. I won't see you next time.
Well, following his final.
That is it.
Crazy.
That is it for Mr. Jerome Powell. His 6-year term officially comes to an end, folks. What a legacy he will have.
Dude, the first meeting from Kevin Warsh is going to be exciting as well.
And
I think
Kevin
that one's
Warsh-
going to be a lot of fun to watch.
Yeah, and Kevin Warsh, we're going to have to pay attention to every single word he says, just like we pay attention to Powell for the past couple of years, given he'll be the new Fed chair. So Look, overall, and Tanner, I guess we'll start off with your thoughts on this, and then I'll go after. But I don't think there was anything that interesting that he said that we didn't already know, right?
Yeah, I think so. I think some of his comments about being a silent chair, or sorry, a silent governor, is one that I don't know how to believe that. Like, do you think that he's just not going to do any speeches? He's not going to go on CNBC. He's not going to go around and talk about the current state, because I'm sure he's going to be the person that is most questioned to come and talk. So I think there's going to be a lot of commentary continuously from Jerome. And I don't know how that changes the dynamic. It's a really rare state where the chairman stays on as the governor. I can't think of the last time where that's happened.
Well, I guess that's the biggest thing to talk about, because everything you said about inflation, oil, the war, Strait of Hormuz, markets, pricing in rate cuts, rate hikes, I mean, quite literally none of that seemed to be any different than what we've heard over the past couple of weeks. So the question then becomes, sorry, I was taking the other stream off. The question then becomes what he really got the headlines going for today, which is that he's going to be staying as Fed governor. The logic, the exact quote was, based on the DOJ investigation, which is now done, left him, quote, no choice but to see things through and stay on. I don't really understand what he means by that. Like,
I saw some comments in the chat that said something along the lines that if he's not part of the board and he's separate, then they could go after him personally or something. Like, it might be a legal thing.
That's a good point. That's a good point.
So he's going to stay at the Fed to protect himself. I don't know. No, I got no legal advice here.
It's either that or, I mean, it's a middle finger to Trump, right? It's like, hey, you shouldn't have investigated me in the first place. You are questioning my integrity of renovating this Fed building or whatever, saying that I'm like grifting from the American people. So now I'm not going to give you full control of the Fed governor board. I'm going to be one of those voices that probably gives Kevin Warsh a hard time. And I think it's very important to understand Kevin Warsh does not like Powell. Might like him as a human being, but I think he thinks Powell has done an absolutely terrible job over the past 6 years, and he probably doesn't want to have to convince this guy when he becomes the Fed chair. But you know, if Powell wants to stick around, then he is going to stick around.
Yeah, I'm sure they'll work together fine. It's going to be interesting.
It's 1978. There was a brief overlap when Arthur Burns stayed on as governor for about 3 weeks. Maybe Powell only stays on for a couple of weeks. So he didn't stay the amount of time, right? Like, he's allowed 2 years, but he didn't stay. So maybe it's a couple of weeks. Maybe it's not even that serious.
Yeah, he said until all the legal stuff is dropped. Which honestly, I believe him. So
yeah, I agree. SPY 711. It was getting a little bit of a hit at 708 while Powell was talking. Nothing serious happening right here with the SPY. AMD trying to go back to 340, up almost 5%. The Q's up 0.5%. Nebius up 5%. Bloom up 25%. Robinhood back above 70. Still an ugly day, but it was below 70. SoFi, I think, almost got below 15. Now it's back to 15.77. Another company, SEMO, Silicon Motion Technology, doubled their sales. That stock up 41% on the day. Micron still up 2%. I mean, even with oil pumping to 107, nothing Powell said really, I think, took the market off of its at least greenish trajectory. So now we got 30 minutes until big tech, I guess, decides the fate of this market.
Yeah. Did you, I think you highlighted it in the chat, but the Meta news that just came out, I think is pretty big, especially for the data center companies.
Yeah, I actually just read the article when Powell was talking. So this is really bullish. I mean, once again, dude, this is really freaking bullish memory. Meta basically saying the memory chip supply is so tight that they're going to have to extend the capacity of different servers they have that might not even be data center servers to be able to run their core business effectively. We did not anticipate the hardware demand growth that we are seeing in the industry. Looking forward to 2027, the binding constraint includes critical server commodities, particularly DRAM and HDDs. DRAM more in the context of, I believe, HDD is for Seagate. I don't think DRAM is for, I think DRAM and NAND are for SanDisk. So obviously Micron, Western Digital, all those.
DRAM is more Micron, NAND is more SanDisk, but Micron does SanDisk and NAND. DRAM and NAND.
We're memory experts now. There you go.
We have to turn into whatever is the new flavor. You know, you got to read up on stuff.
Well,
Go ahead.
Go ahead.
I was just going to say this meta news. Someone said Micron's not really moving, but it's because they're essentially saying, "Hey, we're going to hold on to our current supply even longer."
That's a good point.
Necessarily highlighting that they're buying more. Obviously, the demand is super high, but what I really think this speaks to is the data center names, the Nebuses, the AWSs, the Googles, that the depreciation cycle, like Michael Burry was stating, this is the complete opposite of what Michael Burry said. He said, hey, these are 4-year chips. You're always going to need to get the new chip. And Meta saying, hey, we're actually going to keep these for now 7 years. And so I think that this is anti-Michael Burry's thesis and more beneficial to what Jensen and many of the data center companies have been saying, that they can sell these chips long after many different architectures have already been produced afterwards.
Well, let's get someone on who knows a lot about data centers, semis, and neoclouds. Jose, what's up?
Jose, don't roast me for my take, dude.
What was your take? I thought it was good. I mean, I thought I do think the Micron, first, hello, everybody. Hey, Amit. Hey, Tanner. Hey, everybody watching. I think the meta take was good. Spot on. I think it showcases that servers are going to last a lot longer than expected. So maybe the depreciation rates of some of these servers were, like you mentioned, someone was mentioning that they would be less than 3, maybe 4 years. Now be probably 6, 7 years if Meta is going to be using these servers for a longer time. So it's whoever has compute available right now that's going to be winning. And with memory shortage, I mean, I don't know if you guys talked about it or you guys saw SK Hynix, for example, last week reported earnings. And they saw a 60% quarter-over-quarter revenue growth. But the only reason they saw a 60% quarter-over-quarter revenue growth was because the prices of memory increased 60%. The actual shipment, the shipment itself did not move. Like they still sent the same amount of memory. It was just the pricing itself grew 60%. So it's like we're paying more for memory right now, and we're not actually even getting more memory. So we have to make sure that we're able to use our older solutions for a longer time to be able to withstand at least this crazy memory market that we're in right now.
So before we go deeper into it, Jose, I just want to get your high-level thoughts on this. You still are not a memory investor, but you're investing in a lot of parts of the stack. Why? Like after headlines like this from Met, like why not still take a chance?
So I think last time I mentioned, last time I was here, I mentioned I wasn't a direct memory investor. So I didn't invest in companies like Micron, like SanDisk or stuff like that. Even though the cycle, and I mentioned, I believe the cycle is going to be long. We hear it from everybody. Even SK Hynix mentions that even this year, they only expect bits to grow maybe teens, if that. So the demand is more crazy than what the supply is coming out. What I decided to invest was more in kind of like I don't know what's the proper word, companies that benefit from there or companies that still not benefit. So Silicon Motion was one, Simon, right? That was one that I've been investing in. Form Factor is another one. And Rambus was another one. So I kind of invested in adjacent plays throughout the memory play. I can't. I don't have the Rambus is my weakest one right now. Luckily, it's been before that drop that we purchased. But Simon's doing really good, and Form Factor is doing really good for me. Yeah, it's more the adjacent plays. I don't think I have the stomach for the volatility of the SanDisk, of the STX, of the Seagates, of the Microns. So, but yeah, those are doing extremely well.
Oil's now at 108.25 right now.
I don't think the market cares, right?
I mean,
like
there's a couple red candles.
Where? Like,
well, yeah.
I mean, it's like Bloom is up 25%. Like this is one of the most high beta names that's out there. I know they had a good earnings, but you would think they would care. They don't. It's quite incredible, right? Like it's either artificial that the market doesn't care about it right now. The Qs are green, but if Powell being slightly hawkish can't change the market, if oil being up 10% in 2 days can't change the market, I guess it's big tech's turn to decide if they change the market tonight. Bloom right there, 283. NVIDIA as well. Is that one red? NVIDIA is 209. Yeah, Bloom can run on hydrogen. That's why. That's why it doesn't matter. Nebius 141. Okay, Jose. So here's another question for you. The neoclouds. Do you agree with Tanner's argument that the neoclouds likely have more longevity if Meta is essentially increasing the depreciation schedule on these servers?
Yeah, 100%. I mean, it means they're going to be able to, the exact reason Tanner mentioned, they're going to be able to increase the life of their servers, and it'll be more accepted, right? They've already stated that some of these servers can last a lot longer than 5 to 6 years. But in accounting values, they've still run them around maybe 5 years, and the market has kind of questioned that. I think with news like this, the market will no longer be questioning them if they can actually run this long time. I actually think they can run a lot longer than that. So anybody who has servers turned on, I'm very bullish, and not just the neocloud, but all cloud service providers. And I think for big earnings today, everybody is going to say the exact same thing. We are compute constrained. We are not going, and that's not changing next quarter or the quarter after that.
Before we get into the preview of Meta, Microsoft, Google, and Amazon, I'm going to put a poll in the chat which one people think will perform the best. Real quick, Jose, Intel is just, are we in the new world of server CPU shortages and we just have to accept it?
Yeah, right now, I mean, luckily during earnings call, they mentioned a lot of things for the CPU shortage space. First, they mentioned that they believe this CPU shortage is going to last in 2026. Then they're even expecting growth in 2027. So it does seem like the CPU shortage, at least based on what they were saying, is going to push on at least to next year. So that's extremely bullish. The other thing is for Intel, they are seeing a lot of great traction on their manufacturing business, right? When we did Tesla's earnings call, Tesla kind of called out, Elon called out 14A for production. It kind of reduces some of the risk behind Intel. The other thing is during the earnings call, Intel also mentioned that the advanced packaging business, the CFO even said that he himself only thought it was going to be like $100 or a few $100 million business. And with the revenue visibility that they're seeing, that part of the business of manufacturing is getting closer to the billions already. So it's for them, it's a double whammy right now, and it's the excitement of the CPU shortage and the excitement that the manufacturing business is no longer as questionable as maybe it was a year ago.
I put a poll in my chat just to see which company people think might outperform. Meta's leading the charge at almost 40% of people saying Meta's going to do the best. 30% say Google. Very interesting.
I'm at Meta 40. I'm at Google 30. Amazon 20. Microsoft 11. Okay, the expectations are pretty.
Yeah, dude, we have the exact same chat.
People are going from each chat to vote on it.
Yeah. But it's interesting how negative people are on Microsoft going into this.
Okay, so Tanner, we'll start with you. I mean, which one do you think outperforms? And if you had to pick one to hold throughout the print, I know you own multiple of these, but which one would you pick?
Yeah, I own all of these. So I'm gonna feel it regardless. But I think Microsoft, similarly to ServiceNow, has the potential to really surprise, but that also means that it has the possibility to have the worst. I just think because it's going in so sold off, but yet they still have the data center plays that they could greatly surprise to the upside. But I also think that with Meta, just because, you know, we're expecting what, like 31% year over year growth, and yet the market still hasn't recovered back to where they were since last earnings. Since it sold, or maybe 2 earnings ago, since it sold off. So Microsoft or Meta, I would put my vote there.
Jose, which one do you think catches the bid?
You know, if Microsoft is not as compute constrained as they were last quarter, I think Microsoft, last quarter, they got punished a lot because Azure growth is still kind of just staying at that 37, 38, 39%. growth for them. And the main reason is they're just compute constrained. If they had more capacity, they would have been able to grow faster. So if maybe Jensen threw them a bone and was able to give them a lot more chips this quarter, I think we can see surprise there. So I want Microsoft. I own all four, very similar to Tanner here, that we're gonna see. So with whatever happens, I'll feel it one way. So Microsoft would be my first. The other one, I think Amazon. I think Amazon's cloud solution, even though we're already expecting strong growth in AWS, I actually think it's going to be even stronger than what we expect. The CEO has been extremely active on X. He's been extremely proactive on this OpenAI stuff with Amazon and OpenAI. So his excitement, I think we're either going to see with the AWS numbers today or with guidance or commentary for AWS in the next quarter.
Yeah, I
What's
agree.
your vote on?
I think Meta. I think they're gonna have the best, but I feel like now Meta is becoming so consensus that it might not. But I just think they're gonna show the most amount of actual top line revenue growth. And I mean, this stock should be closer to $800. Like I think the average price on the street is like $850. So I think it's Meta, but we're gonna find out. But I agree with you, Jose. All the cloud CEOs, Thomas Kurian of Google, which I have a clip of, we'll look at in a second, Jassy, they've all been saying the same thing. If we had more compute, cloud would be growing faster. And so maybe they end up all raising CapEx. Neil, Mr. Couch Investor, has joined us. Which one of these Max 7 do you think outperforms today?
First of all, first time I'm seeing you like this. Handsome young lad with a nice haircut and no
You
cap.
are not going to help beat the allegations with that compliment, my good sir. But continue.
Yeah, I think Meta, because I think for me it's Meta, Amazon, Google, Microsoft. Although Microsoft is just last place, not because it's going to be bad, it's just not going to be as good as the others. But Amazon I think AWS kills it, but they will talk about maybe higher energy pricing impacting their logistics business, plus also their data centers getting hit in the Middle East probably is going to cost them a bit. But yeah, to me, it's Meta, then Amazon and Google quite close to each other, then Microsoft. Yeah, because Amazon is going to win big, especially now that there's this new sort of agreement with OpenAI and Microsoft. And like Jose said, I mean, Amazon just jumped on it like Margot Robbie is just single, and you're like, whoop, mine. Okay.
I think Neil came back from Vegas a different person, dude.
Yeah, seriously.
I've never heard Neil this unfiltered, dude. I love it.
It's a beautiful, beautiful day today when you don't look at your portfolio.
Yeah, we just did a stream together for SoFi. It didn't feel like this. He's in a different mood.
He wasn't talking about Margot Robbie with SoFi.
Yeah.
Oh my gosh.
But you know what? Google Cloud is going to show off potentially more than 50+% growth and potentially expected all the way through 2026. But last quarter, we saw a major step up. If we just see 50%, that's one thing. But if we see like high 50%, like 56% growth year over year, I'm going to flip my desk. Like, it's going to be very exciting.
Will you actually flip your desk?
I don't think I have the pure strength to flip. I've never shown my setup on stream, but my desk is probably a little too heavy for me. Yeah, I'll flip something. I'll throw my cell phone.
To your point, this was the Google Cloud CEO around how large demand is becoming around cloud.
Been talking about how Google is in such a unique position. They have the cash cows, they have chips, they have the models. Does your Gemini team ever come to you and say, like, we don't have enough? Or I know I'm really sticking on this point. It's just so wild for me to hear where these other companies are just not able to keep up.
There's always demand for these things, and I think for the next 10 years, there will always be more demand than supply. And that's a good place to be in if you have your own chip. If you don't, you're reselling other people's stuff. And in a capacity constrained environment, your unit economics get more expensive. And in our case, because we control the chip, the unit economics remain attractive. So that is going to be an advantage for us because we own the silicon.
10 years. I mean, Jensen talked about a couple trillion of capex by the end of the decade. Jose, if they all increase capex guidance again, what's the bear and the bull case? If they increase capex, how do you think the stocks fall, and how do you think the stocks react positively towards it?
Oh man, that's a crazy question. First, I'm expecting, at least for this quarter, maybe more tightening than actual capex increase, because I think last quarter they gave us a very long range of capex. Like I think Meta did 115 to 135 for capex. I think what we're going to see this quarter is more of just like increasing the lower range to make the range tighter. So maybe from 115 jumping to 120. Then maybe later throughout the second half of this year is when we actually see the capex grow on the top end. But for me, what I'm expecting this quarter is more just a tightening in range from the lower end actually going up. How the market projects, I think, is different for every player. I think for Meta, people always wonder what they're going to do with all this capex. For Google, sometimes it's like, hey, you have your own chip, so you're doing good. For Amazon, they'll be a little bit iffy. It's like, you're really going to go free cash flow negative this year, right? So it's like, I think for each of them, there's a different story. So even if they all increase capex, they're all going to react differently based on the commentary they share.
So do you think any of the four are going to raise the upper bound or the upper side of the range on capex?
The hopeful side of me says yes. I truly wish, and my portfolio wishes, right? I do think yes, but I just think at least for this right now, maybe
it's too early.
Too early, just because of any potential delays in maybe building a data center or something in between there. Right.
Yeah.
Just I think I think it's more just they want to make sure that they have the visibility correct. If they increase the upper end, in my opinion, because I know we've seen a lot of reports recently where data centers are slowing down or they might not be pushing. If they completely increase the top end, I think that should eliminate that theory, because it means they have all the visibility that they can spend that money. But I think right now I'm playing it safe. I think they're going to be more conservative and just do kind of the lower end range.
Could I clarify something in that statement that Jose said? Was it's not that we're seeing slowdowns in AI demand. It's that they said the shipments were slowed down because they have nowhere to deliver them to. There's not enough like data center space in order to deliver the GB300s or potentially Vera Rubins. So we were seeing slowdowns just because they can't set up the land fast enough.
And Tanner, I would say if there is this today, a world where maybe they decrease the top end. Let's say there's a world that they decrease the top end in capex this quarter. It's because of that reason that you mentioned. It's not the demand problem. It's more of the actual infrastructure problem. Now, if that happens, I think every media news is going to run it as a complete bearish thesis. And if that was to happen, I think it would be one of the best buying opportunities for AI stocks. It would definitely be a complete red show. I don't know if we curse in this show, so I didn't want to curse. But if that does happen, if we see a decrease in the top range, is because of the visibility of building data centers, not demand issue. Media is going to run it completely negative, massive sell-off, great buying opportunity.
Yeah, I think they would keep the flexibility open to have the higher bound. Like, I don't think we're going to see any decrease. Even if it does come in that range, they don't have to tighten the range. So they probably just leave it there just in case if they do see potential to increase the capacity later on. Sorry,
the problem is, like, all of this capex has been helping all of these smaller derivative companies, like these tertiary players that benefit, right? Like an Amcor benefits from more capex, or a Micron benefits from more capex. But the companies spending the capex should also be benefiting because they're the ones spending the money. They're the ones that are getting the growth. And for the better part of basically 7 months since October, they haven't. I mean, maybe excluding Google and Amazon recently on the breakout. So I think maybe this earnings is the time for Meta to get back to 750, 780 and have a real premium. Maybe it's time for Amazon to be treated as a company that's accelerating off of a insanely hard base with AWS. Maybe it's time for Microsoft to get some love and for Google to continue showing that growing GCP at 48% means that they should be trading at a higher multiple, even though, you know, Google has been doing well out of the other four. And I wonder if the capex increase once again, as Jose says, gets the street to be bullish on the smaller companies that are going to get that CapEx, but not bullish on the companies doing the CapEx because they still don't know if they're going to get that ROI. So any increase in CapEx, whether it's towards the high end of the guide or there is no guide, or there's just a flat number, it needs to be associated with massive levels of either guidance for revenue growth or revenue growth in Q1. And if not, yeah, it's going to be ugly, which I think we all hope won't happen. Meta.
On the Google Cloud, Cloud stuff, last quarter, year-over-year growth, 47.7%, right?
Mm-hmm.
This quarter, we are lapping a very, very easy year-over-year comparison. So wouldn't be surprised if we see 50%, like Tanner said.
We're expecting 50+% for full year 2026.
Then yes, then I would not be surprised to see well above 50. And some margin expansion, because last quarter was 30% or so. I mean, they still have a couple of percentage points to go until they reach AWS type levels. So it's going to be, Google is insane.
Does anyone think all four miss?
Oh my God.
That was my next question. Maybe not miss, but what would make them drop other than misses? But let's say they
CapEx.
Don't miss. Just CapEx?
Maybe not just, but like we've been in this weird space where CapEx makes them drop. And then whenever they say, hey, we're not going to be spending as much and we're not continuing to build out, that sells it off. But yeah, I think CapEx.
The implied move is around 7 to 8% on all of them today.
Wow, that's crazy.
What about like advertising spend for Q1?
That's really good. I read a couple equity reports last night. Basically, all the sell side said in their industry checks with advertisers, Meta and Google are like phenomenal. Like nothing in the Middle East actually stopped ad spend.
Good. Cool.
I would imagine that doesn't change in the guide, but like, dude, last time Meta beat by a couple billion. They beat by a couple dollars on EPS. Google never has those types of crazy beats because Google just has because they're doing like 100 billion, Meta's doing 50. But if all four of them can have something to the essence of that type of a beat as this big of a company, at some point the street's got to be like, look, like, yeah, we're buying Intel at 100 times forward, but like Meta at 20 can't be that scary. Google at 30 can't be that. Microsoft at 23 can't be that scary.
Yeah, and I'm going to be curious a lot for Meta. I mean, they released a new model, right, this quarter, this past few months. They released a new model with the new super intelligence lab that they have. And last quarter, they also mentioned that they were they designed their GEM model, which was a recommender model that was kind of moving along, very similar to an LLM based on compute. So if we got any updates on that and seeing kind of growth, I wonder if they'll share more data on those AI fronts for them.
What are some of the proxies that we need to pay attention to as well? Like, I don't know if Snapchat's going to move on what Meta says, or like what's the Ray-Ban's parent company?
It's a very long name.
Yeah.
Sounds Italian.
Nebius is not today, for those that are asking. So do not trust your brokers when they tell you just go to the website and get the earnings. Do not trust your brokers. They're usually wrong. But Nebius is not today. I don't know what some of the proxies are, but there are some other names that are important. We have Chipotle, eBay, Cheesecake, KLAC, Ford, Carvana, and then Qualcomm, which, Jose, real quick, I mean, is this thing going to go up or...
Yeah, I mean, the growth story you have is the CPU shortage, and they have some form of server CPU. The only thing that I'm worried about for them is they're very much in the consumer tech space. And we've heard from every kind of player so far that the consumer tech is seeing a bit of a slowdown because of the crazy memory prices. So I think it's all of what the market wants to price in. Does the market want to price in the slowdown in the tech space, or does it want to price in the future potential of maybe them benefiting in the CPU space? Because I think while they have decent tailwinds, I think the headwinds are definitely there. And because I'm negative on it, obviously the stock is going to rip after earnings.
People have been piling into it just as a thesis that this one's going to do what Intel did. And so, I mean, put in the chat. All right, so we got about 5 minutes left. Put in the chat how many of the big four you're in, or any of the ones that you see on the screen right here. or you can just put in what's your heaviest position. And yeah, in the next 5 minutes, we're going to see $12 trillion of market cap move up or down. But there's going to be a lot of names: Snapchat, Reddit, Qualcomm, KLX, NVIDIA, obviously. I mean, all of these are ultimately going to either benefit or not benefit from these earnings.
Reddit is tomorrow, right? Snapchat is irrelevant, let's say. But yeah, I mean, Reddit tomorrow. I don't think Reddit goes down purely because I think, like you said, advertising is doing well. And Reddit is not really a cloud player or data center builder. So whatever gets said on that front shouldn't affect them, I would say. As for the proxies, I guess, yeah, all the smaller neo cloud players, CoreWeave, Iran, Nebius, etc., would definitely move after hours on any comment of capex, supply, demand, memory players. Although memory players are going crazy, but yeah, those are tomorrow.
Neil, are you still in Micron?
Yes, I am. A bit less than at the start of the year, but still, yeah, still in it.
That's why he was in Vegas. He's able to afford all these places.
It's all the semi guys going on vacation, eh?
It says the guy who just came back from vacation.
But I go on vacations even if it's a bad market.
Because he's done that well.
Yeah, exactly.
All right. We got 3 minutes. So here's how it's going to go. All four of us will be looking for the results. Whoever gets it, we'll try to say it so that we can get the information out there. Obviously, priority before all of the other names. The other names are Carvana, KLAC, Ford, Cheesecake, Chipotle, eBay, and Qualcomm are Meta, Amazon, Google, Microsoft. So those are the priority. We're going to try to get all the results, but those are the four ones. 4:30 Google starts, so in 32 minutes. 4:30 to 5:30 we got Google. We're not going to have any time to discuss it because 5:30 Meta starts. 5:30 6:30 is Meta, and then from 6:30 to 7 we'll stay on whoever's left and try to analyze everything we got. But that's what we got going on. Dude, I have some butterflies in my stomach. I'm like actually a little nervous here.
What's the TLDR on this FOMC meeting? Jerome Powell talk. Well, what bearish, bullish? Well, what was the tone?
It was really neutral. He didn't say anything.
Okay, so he could have sent an email. You're saying?
Yes, and he could have made markets worse, but he didn't say anything that markets cared about enough. So now it's up to, which I kind of like, because now it's up to these tech companies to do it. I will say this as well, as we have 1 minute left. Regardless of what happens to these stocks, up or down, regardless of what happens to our portfolios, up or down, I don't really believe in participation awards, but I would say that all of us here are winning for even caring about the markets, because at the end of the day, you could be doing something else right now. You could be watching Netflix. You could be, just not caring about your financial future. But the fact that we're all here, that we care about these four companies, that we cared about a guy wearing a purple tie speak for the last time on the Fed stage, means that we are interested in trying to do something greater than ourselves. And it is cool to be here together as a community. And hopefully we make a lot of money in the next 30 seconds.
PayPal is up 2.5% today, ladies and gentlemen. The end is near.
Based on the market today, if we, or not the market, based on the day that we've had, if I stay live till 6:55 or whatever, I will have been live for 10 hours today.
Wow.
It's been a
There
long
you go.
day.
Here we go. Wednesday, April 29th. The biggest companies in the world reporting at the exact same time, 4 p.m. The stock market is now closed.
Don't mute the bell. You can't mute the bell. The bell's awesome.
Can't mute the bell. And now we wait.
What did you guys say? I was muted.
I got Qualcomm first. That one's down 2%. Qualcomm, Street wanted 10.2. They're guiding for 9.2 to 10 billion. That's on the guide. I don't have this quarter yet. Qualcomm, that's the first one I'm seeing before the rest. Qualcomm down 2.3. That's the first one. Qualcomm, EPS 265 versus 255. That's a beat. Adjusted EPS third quarter, 210 to 230, Street wanted 243. They missed on guidance for EPS. That stock now down 4%. That stock now down 4% on a miss on EPS guide. Oh, and a miss on rev guide. Street wanted 10.2. They came in at 9.2 to 10. So they missed on the guidance for rev and EPS. Meta goes down, no up, no down.
Amazon is down 5-point-something%.
No.
All right, guys. See you tomorrow. I'm out.
No.
Down 6.
Meta was down. Can it flip? Qualcomm down 3. Microsoft's up 1. Meta's trying to flip green. Meta's trying. Qualcomm down 4. Microsoft up 2. Microsoft's the winner so far. That one's moving. Google flat. Amazon EPS. Street wanted $1.60. They came in at $2.78. That's a big beat.
Oh my gosh.
AWS 28% for AWS.
Dude, look at Meta's numbers. Oh, and Amazon's. Oh my gosh.
Okay, Meta's getting hit. Meta's down. Amazon,
EPS
unbelievable.
They were expecting $6.82. They got $10.44. Beat by 53%.
You're lying.
No, they beat by 53%. EPS is up 62% year over year, and revenue's up 33% year over year to $56.3 billion.
Some of these things don't make any sense. Like for Amazon, it's definitely a one-time tax benefits, and for Meta, it has to be the same thing. Because how can you beat like this?
I mean, maybe it is taxes, but if it's not 53%, they did erase CapEx, unfortunately. But again, with these types of beats, maybe they're allowed to. Meta CapEx is up to $145 billion, not 135. Nice. 125 to 145 instead of 115 to 135. Google CapEx 35 billion versus 36. Google revenue 109 versus 107. That's a beat. EPS beat 283 versus 263. Cloud revenue 20 versus 18. That's a beat.
Okay, Meta has a $8 billion income tax benefit that was recognized in the first quarter.
Okay, there you go.
Meta?
Yes, sir.
So they actually missed.
Well, we don't know yet fully. We'll have to do the numbers.
$8 billion tax benefit. That's so they should have gotten $2 billion. Oh no. Sorry. I was getting my numbers mixed up.
Google is the one that's winning. Meta down 5. Google again. Revenue, that's a beat on first quarter revenue 109, 107. They beat by 2 billion. Cloud 20 versus 18. EPS 282 versus 263. The Googs is at 367. Qualcomm down 4.
There was another memory name that just reported after hours, Form Factor.
Google beat EPS by 94%.
But did Google have a benefit or anything? Is like SpaceX?
I assume so.
It's
they
either
all are having
benefits
insane
or
beat.
Anthropic stuff, no? Investments in other companies, whatever they do. But
oh yeah, could be long-term investments.
Yeah, guys, the 511 versus 2. The street doesn't get it that wrong. That's got to be again.
Yeah. But still, though, look at revenue. Revenue beat by 3%, 22% revenue year over year. That's amazing.
Meta makes no sense to me. I don't understand why that's dumping, but there's got to be something the street doesn't like.
Are you playing earnings?
No, I'm not playing it. I mean, technically, I'm in all of these, so yeah.
Okay. All right. No. All good.
But this is unbelievable. Amazon, why is that one also? I mean, I know the move was priced, but 5% on, or actually 2% on Amazon here was 5%. 259.
Meta increased CapEx, by the way. I mean, yeah, it's now in the range of 125 to 145 billion dollars, up from 115, 135.
Yeah, I like it better when you say it opposed to when Amit said it 5 minutes ago.
Yeah, Amit said unfortunately, and me and Jose were like, "What do you mean unfortunately?"
It made the stock go down. That's why it was unfortunate.
Yeah.
Here's Amazon.
It's pretty much flat. It dipped a little bit, but it is a beat on the top and the bottom line. Earnings per share coming in at $2.78 versus $1.64 the street was expecting. There is a $16.8 billion gain on its Anthropic stake, though. Revenue coming in at $181.52 billion versus $177.3 billion expected. Operating income guidance for the second quarter. This is what the street was really looking for. Amazon is guiding for between 20 to 24 billion. The street was expecting 22.65 billion. So that's sort of the midpoint of what they gave out. The stock, though, has now lower by about 3%. So we're going to continue to dig into these numbers and find out what the culprit is for the stock moving lower, although expectations had moved down on the quarter.
Did you guys see Google's cloud revenue growth?
No, what do we have? What do we got?
63%.
Oh my goodness.
Dude, look at this. This is ridiculous. Even search is growing at 19%. Tokens per minute are up 60% quarter over quarter. Paid subscriptions up. Waymo's doing well. 63.
The table.
$460 billion backlog. Oh my God, that's like double what it was last quarter.
Yeah, that was like 250 or something last time, right?
Oh my God, bro.
Cloud revenue 20 versus 18, YouTube 9.8 versus 9.9. They missed on YouTube. CapEx 35 versus, they actually missed on CapEx, which is good. They were a little bit shy for Q1.
I'm telling you, Google is going to be such a giant. Like, they already are, but like, they are so well positioned to dominate in artificial intelligence.
Amazon. One good thing about Amazon, as Google keeps pumping, is operating margins are up 2%. Like, that's really good. 11.7 to 13.1. That's a very healthy increase on their operating margins, which were at 5% a year ago. Physical stores 5.7 versus 5.8. Operating income 20 to 24 for Q2. Street wanted 22, so that's on the high end. It looks like they benefited from Anthropic as well because they beat EPS by like 80%. So all these companies getting some type of a pre-tax gain there.
Yeah, I wonder if that RPO was because of Anthropic, right? They announced the Anthropic
could be
expansion this quarter, and I was reading it said RPO doubled quarter over quarter, almost doubling, and I think that was the only big contract they had, unless they secretly are working with OpenAI, and we might hear about it soon.
This is what we have for Googs.
Versus the $107.2 billion estimate. EPS coming in at $5.11. At this point, we are not comparing that to the street estimate of $2.63. We've also got to read on Q1 cloud revenue. This is really a tell on whether that massive AI infrastructure push, especially on their in-house chips, the TPU, is paying off. That's coming in at $20.03 billion versus the $18.05 billion estimate. That is up 63% year over year, beating even the whisper number of 50% growth. Last thing I want to point out at this point, dividend, it's 5% increase to dividends, resulting in a 22-cent dividend for the quarter. Mel, I'm still digging into this for now. Shares up around 3.5%.
All right, Mac, thank you.
Microsoft, did they end up flipping red? No, but they lost their candle. Amazon ended up flipping a little green. Sam joining us. Any reaction to these numbers?
Man, at AWS 28%, I'm still looking through the numbers, but Google Cloud is insane.
I was going to say 28%. I mean, that pales in comparison to 63%. Somebody's taking market share here.
I mean, isn't AWS twice as big as Google? I mean, still,
Yeah.
that's pretty tremendous.
But sorry, can I bring up another little thing here? Meta dropped in terms of total members for the first time in I don't know how long.
That might. Do you have it right now?
Yeah, I can.
There is an explanation.
Okay, all right.
There is an explanation. They said it dropped slightly because of internet disruptions in Iran, as well as restrictions on access to WhatsApp in Russia. That said, ad impressions are up 19%. Average price per ad is up 12% year over year.
Can I just ask about the WhatsApp thing? That happened this quarter? That didn't happen over the Ukraine-Russia thing's been going on for a while. They're saying the WhatsApp thing happened right now?
I mean, if you want me to call Zuck and ask, I don't know.
Please.
I'm sure he'll talk about that on the call, but the Iran thing seems to be a bit more prevalent given there's 92 million people there. Revenue up 33% year over year. Expenses were up 35. CapEx again increasing by about 20 billion. Probably part of the reason they did the headcount layoffs is because of this increase in CapEx that we're seeing by 20 billion. Price per ad up 12%. Ad impressions up 19%. I mean, that is hard to do. Increase that by 19%. Maybe the increase in CapEx and slight decline in users. Maybe that's it. That's your story for why Meta's down.
Sorry, did you cover Carvana and Ford yet?
No, we'll do that right now. Carvana's up 10, of course. Beat EPS by 8%, 169 versus 156. Revenue 6.4 versus 6.1, beat by 5%. Double beat. There you go. Carvana's up 10, even with a heavy short ratio. Net income margin 6.3, adjusted EBITDA margins at 10%. They sold about 187,000 cars.
Ford is up almost 7% as well.
Ford, wow. 66 cents versus 19 cents expected on EPS. Did they invest in Anthropic early too? Like, what is going on?
they pivoted to data center.
No, but every
Ford
company's
AI.
beating by like 200% on EPS. Yeah. Adjusted EBITDA 8.5 to 10.5. Street saw 8 to 10, so they beat on the adjusted EBITDA guidance as well. Oh, they got a tax refund. Okay, there you go. That explains it.
Yeah, the biggest tax refund in history just went to the corporation.
Microsoft down 3. Oh, did we even look at Microsoft's numbers? Is anyone? What did they do on revenue?
Not yet.
Oh, so none of us cared about Microsoft. The freaking
Dude,
what are we doing here?
Google Cloud operating income grew 154%.
Okay, Microsoft beat on EPS by 5%. Beat on revenue by 2%. Street doesn't care that much.
What was their cloud?
That's a great question.
40%.
Was it actually 40 with a 4?
Yeah, Azure and other cloud services revenue increased 40%, 39% on constant currency.
Okay, so they met their cloud numbers. They didn't accelerate like AWS, but that's not bad, right?
Yeah, it's not bad, but they're all paling in comparison to Google Cloud right now.
Yeah.
And the operating margin that Google Cloud is actually seeing on their cloud too is also very impressive.
Yeah, it's amazing. They're massively growing their operating income compared to the other two.
Yeah.
Nebius getting hit after hours. Iran getting hit. Wait, why? Why is that expected for Nebius?
I mean, just you have a lot of med caps going down, but I would say that.
Oh, but if they're increasing CapEx,
market's going
good,
down.
right?
No, but look at the market. Market's down, or the Qs are down 65 basis points after hours. So it's going to impact. I mean, ultimately, the guide is really going to tell the story for these data center stocks, but they might need to cool off a little bit.
Wow. So Google's the only one that survived it. Wow.
So when is Google flipping NVIDIA for that number 1 spot?
Watch your mouth.
Yeah. Wow.
I wanted to activate Jose a bit. He's been too quiet.
Dude, well, Meta, headwinds in the EU and US could significantly impact results. Headwinds about what?
The kids not being on social media is one thing.
Oh, the cyberbullying thing.
And the other thing is the EU making sure they make money from US companies by fining you billions of dollars every year.
It's their favorite.
Now, they're saying significantly impact results, but I think they also have to disclose that. This is a company that just grew 33%. Unless that goes down to 25% next quarter. I don't know how significant. Google's given up some of those gains, folks.
Yeah.
Google's joining the red party. Oh, boy. Amazon down 3.
So this kind of makes sense why Nebius is down a lot more from it is because they have the Microsoft deal and they have the Meta deal. Now, I'm just basing it on how those earnings are performing versus Google. So the fact that Google, Meta, and Amazon are down significantly. I mean, Amazon not really as much, but that explains why Nebius is down the most out of all of them. TeraWolf is only down 50 basis points, and they have the Google backstop. IREN is down 1%. So just a guess.
No,
But the Qs are down 80
very-
basis points after hours.
It's a fair point. And by the way, Google's net income, 36.9 billion they got the benefit of, which is why they beat so heavily on EPS.
And by the way, I mean, the little disclaimer there from Meta at the end has been put there, I think, for the last couple of quarters. I checked too, and it was there already. So the usual stuff.
Yeah, so then CapEx, I guess, is the reason. Here's Microsoft's, their earnings as well.
For Microsoft, for the quarter, $627 billion. That is 99% year over year. So that's a big number. But I would point out it's a slower pace than the prior quarter, which RPO came in up 110% year over year. So something to take into account. And once again, as we look at those CapEx numbers, now the street was looking for $35 billion on CapEx in the third quarter. The company here is saying 31.9 for the third quarter, which is really interesting given the broader concerns around CapEx. Is it growing at a faster pace than Azure? We have comments here from CEO Satya Nadella of Microsoft. He says, we are focused on delivering cloud and AI infrastructure and solutions that empower every business to evaluate their outcomes in the agentic computing era. Reminder to our audience, Microsoft guidance comes out during the earnings call, which begins at 5:30 p.m. Eastern. He also points to one specific metric, AI business surpassing an annual revenue run rate of $37 billion. That's up 123% year over year. Guys, I'll send it back to you.
Seema, thank you. Let's bring in Brent Thill. He is Jefferies equity analyst, and his coverage includes Microsoft, Google, and Meta. Brent, great to have you. Let's just start with Microsoft there. What did you see? The market is just, backing off slightly. Obviously, we're getting a lot more detail on the call.
Yeah, Microsoft was largely in line. Azure hitting the high 30s, M365 mid-teens, CapEx kind of in line, and continued good operating margin improvement. So if anyone thinks you can't make money in AI, Amy Hood, the CFO of Microsoft, telling you that you can make money on AI and improve margin. So we continue to think that it's consistent, stable. They pulled a Wayne Gretzky and RPO up 99%, which is great to see. And I think it's pretty straightforward. I think the challenge is when you look at the Google backlog, up 90% sequentially, it looks like Google's taking market share across all these clouds.
That's kind of what you were saying, Tanner, as well. KLAC. Go ahead.
No, I was just gonna say Google's the only of the Mag 7 that's remaining green at all, but they're giving up all of it right now. They're at one point almost went red.
KLAC down 7. Form Factor is up 15. Form Factor this is kind of a memory play as well, right?
Yeah, that's Form.
Okay, so literally the market just cares about memory at this point. Like did all these companies cure Alzheimer's or something? Like every memory stock, it doesn't matter.
Was that a joke? That was funny.
Thank you. I appreciate you acknowledging that. But
I get it. Smart man. That was good.
The chat's going to be upset because I used that joke 2 months ago, but not when you guys were live. So, you can recycle different. But I don't get it. Meta's growing 33%. They're spending a little bit on CapEx, but Form Factor catches the bid. I mean, this is Amazon accelerate AWS for the first time in 3 years, down 3%. I mean,
actually, they re-accelerated.
Sorry, re-accelerated. Yeah, because last quarter they accelerated again as well.
Yeah.
I can't even believe Google's not way more green. Google search is doing so well. YouTube ads are doing well. And Google Cloud's doing well. What else do you want?
Oh, how's the NVIDIA doing? It's not down that much.
Let's get the update from Meta.
A couple of key other factors to flag here. The company's revenue guidance for the second quarter is in a range of $58 to $61 billion. That's right in line with expectations, given the fact that the company reported higher than expected revenue in Q1,
Perhaps a disappointment that it's not going to be growing consistently into Q2. Another keynote here, Reality Labs. This is the metaverse division, reporting a loss of $4.03 billion in the quarter. That is less than expected and smaller than the Q4 losses of $6 billion. And then one other note here is, so it looks like we maybe hit a peak in terms of Reality Labs losses. Daily active people actually decreased on a quarter-over-quarter basis and fell short of expectations. The company saying that was driven by internet disruptions in Iran, as well as a restriction on access to WhatsApp in Russia. So the company ending with 3.56 billion daily active people for the family of apps. Shares down about 6.5%. Melissa?
Julia, thanks. Julia Board.
Really quick, can I relay a message from Stephen Fiorillo?
Go ahead.
Because he's just texting me right now. He said, I just wanted to call to say Meta's price action is criminal. Zuck destroyed earnings. Oh no, they're spending an extra 10 billion on CapEx. The stock market. These people are so stupid. He's pissed. He is pissed.
The soundboard was very effective there.
Yeah, that was really good.
Yeah. Yeah, this is I think these will recover, obviously, but this feels like a rug. This feels like a rug right now.
Well, we do get CapEx guides during the call.
Well, we already got Metas, right? I mean, I guess we'll
AWS you get during the call.
It doesn't
Microsoft during
matter.
the call.
Increased capex is bad. Decreased capex bad. Same capex also bad. So.
Well, I bought my ramen from the supermarket this morning, so it's probably gonna be sold out. So I don't need to worry about that.
I swear, though, Neil, that's actually what people are doing now, though. If any change, up, down, anything, they sell it off.
Oh man,
it's a very no calls at 4:30 for Google. Qualcomm getting a little bit of a hit here. They missed on everything.
Oh, they weren't. No, they're up 5%.
No, they were down 5% before you came.
Yeah.
So that's a turnaround.
It's probably the OpenAI phone that nobody's going to use.
Maybe that's it. I mean, look, again, Qualcomm did not put up an Intel type of quarter that people thought they would. Not at all. Not even the slightest. So whatever the street's buying it for right now is got to be for some reason. But this is interesting. It's interesting to see Seagate and Bloom go crazy yesterday and NXPI. Yeah. And then the companies that are spending all the money that benefits them. It's almost like Google, Meta, and Microsoft are piggy banks for these smaller companies. And these smaller companies are the ones that actually get their stocks to go up. And the bigger companies spending the CapEx don't get anything. It's
I want to share my screen. I'm just showing Google's long-term investments, which just went up an additional $40 billion quarter over quarter. $40 billion.
Is that mainly SpaceX and Anthropic?
Yeah, I mean, along with other things, but yes, that's a big part of it for sure.
At least Google's holding on to the pump. Like that cloud growth can't be denied, I would imagine.
I would like to eat steak tonight. I don't want to eat ramen.
Dude, the only steakhouse you're going to tonight is Texas Roadhouse. You're not going anywhere else.
That's a pretty good steakhouse.
Yeah, the bread is nice.
An affordable steak.
That's good. Amazon is only down 1.5%. So now it's, is this baby going to go green? Let's go.
Sundar Pichai, 2026 is off to a terrific start. Our AI investments and full stack approach are lighting up every part of the business. Search, a strong quarter with AI experiences driving usage, queries at an all-time high, 19% revenue growth. Google Cloud revenue grew 63% to $460 billion. Backlogs. This was our strongest quarter ever for our consumer AI plans driven by the Gemini app. Overall, the number of paid subscriptions has now reached 350 million. With YouTube and Google One being the key drivers, Gemini Enterprise has great momentum with 40% quarter-over-quarter growth. And finally, I'm pleased to announce we have 500,000 rides a week on Waymo. Mm-hmm. Gemini is now 16 billion tokens per minute. They didn't put how many users they have for Gemini in terms of monthlies. Which kind of leads me to think the number is not that compelling because usually they say that. Right? Like last time they said 650 million.
Yeah, they said Gemini Enterprise paid monthly active users is up 40% quarter over quarter.
I'm talking about the ChatGPT competitor. How many people are using that? I thought they would be closer to 800 million. So
I don't know. I recently just switched from Gemini back to ChatGPT. So,
our man.
They all have their strengths.
ChatGPT is so good now. Honestly, people clown on Codex, but with ChatGPT 5.5, it's amazing.
Even the image generation?
It's unbelievable.
Yep. It
The
got
new
so much
version of the
better.
image generator, it's the best.
I gotta
Ridiculous.
check
Yeah.
that one out. Yeah, I used to use Gemini a lot for image generation.
Yeah.
Okay.
Wow.
Qualcomm.
Qualcomm 10%.
If you put in the chat, if you actually picked this one up, but this is the winner today.
Let's see.
I can't see the quote on what they said that's getting the street to be this excited. I'm going to try to find the quote. But the numbers, we already read them, were misses on every metric. Street likes it, 9%. 9% on Mr. Oh, we got so many other earnings, dude. We didn't even look at them. Ford's up 2, Cheesecake's down 1, Chipotle's up 1, eBay's down 2.
eBay.
We looked at Carvana. Chipotle beat by 12% on revenue. They came in line on EPS. EPS is down 17% year over year. Viavi also had earnings.
Oh, yeah. How did that do?
That stock up 14. Revenue beat by 5%. EPS 27 versus 23. Revenue guide beat by about 30 million, which is really good. EPS beat by about 7 cents, which is also really good.
Stock talk is definitely one happy camper today.
Yeah, Viavi getting a nice little bid right there. The Qs are down 0.3. Corrigan, Nebius, and Iren still down.
I'm heavily contributing to Chipotle's revenue beat this quarter. So, not as a shareholder, but as a customer. So you guys are welcome.
Thank you.
Let's get a little bit of...
I didn't know whenever you said that you were a chip investor that it also meant Chipotle.
Yeah. Using it for the AI data center pivot.
No, for the chips and guac, dude.
Yo, you're on fire today, dude.
Oh,
No,
Sam, did it take you that long to catch on to that joke?
It took me a while to catch on to that one.
He said AI data center pivot.
Yeah, I know, but you said chips and guac. I was like, wow, that was pretty good.
I mean, I think it's across the board. There's a skepticism that all this CapEx dollars is going to pay off in an ROI, and it's a greater focus on Meta. To your point, they're not among the top 3 hyperscalers running corporate workloads. So what are they using it for? They're using it for their ad business. They're using it for the future of their platform. When you think about interactive content, when you think about what they're going to do with the glasses. And I think the first wave of AI has paid off for Meta, and you've seen this, and you're not going to, you're seeing close to 30% revenue growth because that first wave of AI paid off with really good margin. I think the second wave of AI investment, everyone is freaked out. Is this just going to be wasted on new things that don't have the same magnitude of return as the core platform? And so I think that one still remains. There's a cloud over the stock. And ultimately, what's going to happen in the next gen of this AI build out is a bigger concern. And then the lawsuit. Clearly, we're seeing the lawsuit as an issue, and the user number I think is also somewhat of a red flag tactically. But again, I point to Q1s are never like insanely good for Meta. Only soft quarter for advertisers. They didn't seem like they put up a seasonally soft quarter in advertising. In Google beat by 2% in their ads business. So
right.
It wasn't that bad, but it was, I think, again, just the magnitude of the cap.
I agree. If this is a CapEx story, these stocks are going to recover. I wonder when, but this can't be something where Meta's going to drop below 600 tomorrow. Microsoft's going back below 400.
What waves is he talking about? To me, it's just been one constant blast of CapEx spend. I don't know what waves he's referring to.
Yeah.
Has there been waves of investment in data center spend?
No, it's a fair point. But the problem here is that the CapEx is up, but so is the revenue growth. So if the street's going to pick on, at least for Meta, users or like the lawsuits, which I mean, people cared about on March 30th. No one seemed to care about it when the stock went up after that. I think that's a silly reason to get upset. I mean, they grew 33%. What are we talking about? $2 trillion company doing that.
Yeah.
And what does this mean for NVIDIA if all these guys stay down? Is NVIDIA's down after hours, but are they just going to go to the moon because they get all the capex and the other Max 7s get nothing? Like,
Curious to see what Broadcom is doing. Is that one moving?
Broadcom is up. Well,
Yeah, it's
Google's
up.
up, so Broadcom should be up, right?
Marvell's down 1%.
Qualcomm's still climbing, 13% right now.
Yeah, if anyone has the quote on Qualcomm, let me know, because
Someone posted that they mentioned. Hold on, I have it really quick here.
I have something too.
Yeah, the leading hyperscaler custom engagement.
Yeah, Qualcomm is now up 10% after saying its lead hyperscale custom silicon engagement remains on track for initial shipments later this year. CEO said he is confident smartphones rebound after fiscal 3. We can now call the bottom. So it's up 10% because they're saying smartphones will rebound after this quarter, basically. I mean, I guess that is a reason, but you're going to need a lot of smartphones to be sold, right? And their guidance is not implying a lot of smartphones are going to be. They missed on guidance. But I guess it's enough. Google is live. Here we go. All right, folks. We'll be back in an hour. Then we'll get into Meta, but here's Google.
Good luck.
Jim Friedland, Head of Investor Relations. Please go ahead.
Thank you. Good afternoon, everyone, and welcome to Alphabet's first quarter 2026 earnings conference call. With us today are Sundar Pichai, Philip Schindler, and Anat Ashkenazi. Now, I'll quickly cover the safe harbor. Some of the statements that we make today regarding our business, operations, and financial performance may be considered forward-looking. Such statements are based on current expectations and assumptions that are subject to a number of risks and uncertainties. Actual results could differ materially. Please refer to our Forms 10-K and 10-Q, including the risk factors. We undertake no obligation to update any forward-looking statement. During this call, we will present both GAAP and non-GAAP financial measures. A reconciliation of non-GAAP to GAAP measures is included in today's earnings press release, which is distributed and available to the public through our investor relations website located at abc.xyz/investor. Our comments will be on year-over-year comparisons unless we state otherwise. And now, I'll turn the call over to Sundar.
Thanks, Jim. Hi, everyone, and thanks for joining us today. It was a terrific quarter for Alphabet. Our momentum was on full display at Cloud Next last week, and the month of May brings even more with I/O, Brandcast, and GML. I hope you'll tune in to see our progress. It's clear that our AI investments and full-stack approach are driving performance across our business. In Search and Other, revenue grew 19%. People love our AI experiences like AI Mode and AI Overviews, and they're coming back to search more. Cloud accelerated again this quarter due to strong demand for our AI products and infrastructure. Revenue grew 63%, exceeding $20 billion for the first time, and our backlog nearly doubled quarter on quarter to over $460 billion. Gemini Enterprise is seeing tremendous momentum with 40% growth quarter over quarter in paid monthly active users. In subscriptions, this was our strongest quarter ever for our consumer AI plans, primarily driven by adoption of the Gemini app. Overall, the number of paid subscriptions has now reached 350 million, with YouTube and Google One being the key drivers. And our AI models have great momentum. Our first-party models now process more than 16 billion tokens per minute via direct API used by our customers, up from 10 billion last quarter. Today, I'll share our progress across the AI full stack, then Search and Cloud, followed by YouTube and other bets. Starting with our AI infrastructure, it's the foundation of our full stack approach to AI, driving customer growth and product adoption. Our custom TPUs, Axion CPUs, and the latest NVIDIA GPUs continue to form the industry's widest variety of compute options. NVIDIA GPUs are a core part of our AI accelerator portfolio and will be among the first to offer NVIDIA Vera Rubin NVL72 in addition to the Blackwell and Hopper-based instances already available. At Cloud Next, we introduced our 8th generation TPUs, individually specialized for training and serving, and able to take on the most demanding agentic workloads. TPU 8T provides high-performance model training with 3 times the processing power of Ironwood and 2 times the performance. TPU 8i delivers cost-effective, low-latency inference with 80% better performance per dollar than the prior generation. This exceptional infrastructure powers our world-class AI research that includes models and tooling, which continue to progress really well. Gemini 3.1 Pro continues to push the frontier in reasoning, multimodal understanding, and cost. We have quickly expanded the Gemini 3.1 series of models to offer more choices for developers, including our cost-efficient Flash models. 3.1 Flash Live, our latest audio model, has improved precision and reasoning, making voice interactions more natural and intuitive. It's now powering conversational features in Search and the Gemini app. Speech-to-text is now available in 70 languages. And with 3.1 Pro, our deep research agent got a big upgrade, including MCP support and native visualizations. Our generative media models are incredibly popular. Lyria 3 has generated over 150 million songs since launching on the Gemini app. Nano Banana 2 reached 1 billion images in nearly half the time of Nano Banana 1. And VO 3.1 Lite is our most cost-efficient video model to date. On top of this, we launched Gemma 4, our most intelligent open model. It's been downloaded over 50 million times in just a few weeks. In fact, our open models have now been downloaded over 500 million times. Looking ahead, we are focused on pushing the next frontiers of foundation models, including intelligence, agents, and agentic coding. And we are using the latest technologies to transform how we work as a company. For example, with anti-gravity, we are shifting to truly agentic workflows. Our engineers are now orchestrating fully autonomous digital task forces and building at a faster velocity. Much more to come here. Next, we are bringing helpful AI into the hands of billions of people every day through our products and platforms. Earlier this year, we introduced personal intelligence, which helps people get more personalized and helpful responses. It's now in the Gemini app, AI Mode, and Gemini in Chrome. Early traction has been good, and this month we integrated Nano Banana 2 to make personalized image creation possible in the Gemini app. Maps recently got its most significant upgrade in over a decade with Gemini. Users can now have a conversation with Maps and get more personalized suggestions and intuitive directions. And the Pixel 10a launched to positive reviews, providing the best of Google's AI features like Gemini Live and AI-powered camera features. Turning to search, AI continues to drive search usage and queries are at an all-time high. We continue to invest in improvements to AI overviews, which are driving overall search growth, and we're also seeing strong growth in both users and usage of AI Mode globally. Personal intelligence expanded broadly in the US, and we are seeing people ask more personal questions and getting responses that are uniquely relevant to them. We also shipped agentic experiences like restaurant booking to new countries and new multimodal capabilities like Search Live globally. We are also continuing to improve efficiency and speed. Even as we have brought new AI features into our results page, we have reduced search latency by more than 35% over the past 5 years. And since upgrading AI overviews and AI Mode to Gemini 3, we have reduced the cost of core AI responses by more than 30%, thanks to continued hardware and engineering breakthroughs. We are excited to share more about search at I/O. Now, over to Google Cloud. Google Cloud is differentiated because we are the only provider to offer first-party solutions across the entire enterprise AI stack. Our growth in revenue, operating margin, and backlog highlights this differentiation. Our enterprise AI solutions have become our primary growth driver for cloud for the first time. In Q1, revenue from products built on our Gen AI models grew nearly 800% year over year. We are winning new customers faster, with new customer acquisition doubling compared to the same period last year. We are seeing strong deal momentum, doubling the number of $100 million to $1 billion deals year on year, and signing multiple billion-dollar-plus deals. And we are deepening relationships with existing customers. Customers outpaced their initial commitments by 45%, accelerating over last quarter. At Cloud Next last week, we introduced hundreds of new capabilities across our vertically optimized AI stack that are designed to work together for our enterprise customers. We introduced a new Gemini Enterprise Agent platform that empowers users to build, orchestrate, govern, and optimize agents with the controls that enterprise customers need. Along with new capabilities in Gemini Enterprise app like projects, Canvas, long-running agents, and skills, every employee can build agents. In Q1, Gemini Enterprise paid monthly active users grew 40% quarter over quarter. That includes major global brands like Bosch, CityWealth, Merck, and Mars Incorporated. Our partner ecosystem plays an increasingly critical role in driving Gemini Enterprise adoption. We saw 9x year-over-year growth, both in seats sold with partners and in the number of partners adopting it for internal use. This momentum is leading to accelerating usage of our models. Over the past 12 months, 330 Google Cloud customers each processed over 1 trillion tokens. 35 reached the 10 trillion token milestone. To give agents business context from enterprise data to help them reason intelligently, we introduced a new agentic data cloud. It includes a cross-cloud lakehouse, knowledge catalog, and deep research agents, which combine research and analytical skills. As an example, using our data cloud, American Express is enabling agentic commerce at scale by moving an enterprise data platform along with hundreds of production applications to BigQuery. Vodafone is proactively resolving outages, automating network planning, and precisely targeting capacity. Enterprise data has become critical for agents to reason. Our strength with BigQuery and Gemini Enterprise has led Gemini-powered workflows in BigQuery to grow over 30x year over year. As cybersecurity threats from the use of AI models accelerate, our expertise in AI and cybersecurity is driving strong demand for our agentic defense offerings. In March, we closed the acquisition of Wiz, a leading cloud and security AI platform, which is an incredible fit for the moment we are in. We have seen tremendous interest from customers in our unique cybersecurity and AI products and services to protect their IT estate. The performance of Wiz so far has exceeded our expectations. Together with Google's threat intelligence, security operations, and AI models, Wiz is helping organizations detect, prevent, and respond to threats. We introduced new Gemini-powered agents for threat detection, continuous red teaming, and automated remediation to protect software code and cloud systems. Customers like Deloitte, Priceline, and Shell are using our agentic defense to strengthen their security posture. All of this is powered by the AI infrastructure I mentioned earlier. Our TPUs continue our leadership in performance, cost, and power efficiency for customers like Thinking Machines Lab, Hudson River Trading, and Boston Dynamics. As TPU demand grows from AI labs, capital markets firms, and high-performance computing applications, we'll begin to deliver TPUs to a select group of customers in their own data centers in a hardware configuration to expand our addressable market opportunity. Turning to YouTube, where our momentum continues. In the living room, US viewers are watching over 200 million hours of YouTube content daily. And as of March, we've reached a new milestone with over 10 million channels now publishing shorts each day. This level of daily activity is a testament to how people enjoy this content and how we have made it easier for creators. And in Q1, our YouTube Music and Premium offering saw its largest quarterly increase in the total number of non-trial subscribers, both globally and in the US, since YouTube Premium launched in June 2018. I hope you'll tune into Brandcast on May 13. Moving to other bets, Waymo is on a great trajectory. It launched in Nashville a few weeks ago. That makes 6 new cities so far in 2026 and operations in 11 major US cities in total. Waymo also surpassed 500,000 fully autonomous rides per week, doubling in less than a year. Wing continues to expand across the US in partnership with Walmart and DoorDash and announced plans to operate in the Bay Area. In summary, a terrific start to the year with so many great opportunities ahead. We are not slowing down. Huge thanks to all of our employees and our partners. See you at I/O on May 19th. Philip, over to you.
Thanks, Sundar, and hello, everyone. As usual, I start with the performance of Google services and then cover the progress we're delivering across search, YouTube, and partnerships. Google services revenues were $90 billion for the quarter, up 16% year on year, primarily driven by the continued growth of search. Adding some further color to our results. Search and other delivered 19% growth, primarily driven by retail and finance. YouTube advertising revenues grew 11%, driven by direct response, followed by brand. And network advertising revenues were down 4% year on year. Starting with search and other revenues, which delivered $60 billion in revenue for the quarter. We are accelerating the deployment of Gemini across our entire ads infrastructure to help businesses reach more customers in more places than ever before. This is driving significant improvements across all areas of marketing and continues to fuel new performance breakthroughs across 3 areas critical for our customer success: ads quality, advertiser tools, and new AI user experiences. First, ads quality. AI is boosting our ability to deeply understand user intent for a given search query and to find the most relevant ad. Even when we don't have a direct user query, we're making significant strides in improving relevance. In Discover, new AI models and classifiers are driving higher relevance by better aligning ads with unique user interests. In Maps, we're using Gemini to ensure promoted pins are deeply relevant to a user's surroundings, location of interest, history, and intent. This work is improving ads relevance by nearly 10%, leading to significant increase in user engagement. We're pairing this strengthened prediction-driven relevance with bottom-of-funnel precision. Over the past year, we've made over 20 improvements to search and shopping bid strategies. Smart bidding now uses Gemini to match user intent to an advertiser's product and services more accurately and further drive performance. This level of granularity was previously impossible to achieve at scale. Second, on advertiser tools, where Gemini helps advertisers drive more efficient and effective campaigns. People no longer search in fragments. They search conversationally and share more context. We launched AI Max to help advertisers adapt to this new way of searching, and earlier this month, it moved out of beta with improved performance quality across targeting and creative capabilities. Take Hilton EMEA. They captured 1/3 more clicks for 1/5 of the spend, while simultaneously increasing the average booking value by 55%. And Etsy saw a 10% search volume uplift, with 15% of those queries being net new to their business. We see significant opportunity as advertisers continue to make good progress on AI readiness and the adoption of AI tools. For instance, more than 30% of our customer search spend now uses AI-enabled campaigns, AI Max or Performance Max. And these advertisers are seeing more conversion for the same spend. Third, how we monetize new AI user experiences in search. We aren't just bringing existing ad formats into AI experiences. We are reinventing ads for this new era. Direct offers in AI mode are resonating with users and continue to receive positive customer feedback. Gap, L'Oreal, and Chewy are just some of the latest partners who have now signed up to test this Google Ads pilot. We're also exploring new formats for retailers. AI mode already surfaces organic product recommendations based on a user's query, and we're now testing a new ad format that displays retailers who sell those recommended products. In addition, the retail industry is rapidly coalescing around the open source Universal Commerce Protocol, or UCP, we launched in January in partnership with the ecosystem. Last week, we welcomed Amazon, Meta, Microsoft, Salesforce, and Stripe as new members to the UCP Tech Council. They joined founding members Shopify, Etsy, Target, Wayfair, and Google to further accelerate the transition towards an agentic future. Partners like Sephora and Macy's have joined companies like Ulta Beauty, who are already rolling out UCP and can now redefine consumer journeys from discovery to checkout. Ulta Beauty just last week launched agentic commerce within AI mode and search and the Gemini app. Shoppers can now review product recommendations, compare options, and complete streamlined checkout for eligible purchases directly within AI mode and Gemini. Turning to YouTube, which now has led streaming watch time in the US for 3 consecutive years. We're in an unmatched position to connect brands with the audiences they care about in the moment they engage in. We're applying Gemini to drive better matching and discovery between brands and creators of all sizes. And Gemini now powers YouTube creator partnerships, a centralized platform integrated directly into YouTube Studio for creators and Google Ads for advertisers. We've also made it easier to buy premium ad space in top-tier podcast shows by curating the most watched podcasts into popular genres. For example, Supergroup partnered with YouTube creator Lisa Koshy on a multi-format shorts and long-form CTV campaign, resulting in a 93% lift for their glow screen product and a 55% overall brand lift. Looking at monetization across YouTube, momentum continues in Shorts and the living room, and demand gen continues to drive momentum in direct response, in particular with smaller advertisers. Brand 2 is benefiting from growth in the living room, where we continue to scale creator brand deals. YouTube subscriptions revenue continues to grow faster than ads, particularly YouTube Music and Premium. By the end of Q1, YouTube Premium Lite was fully launched in 23 countries, and we plan to launch in more than a dozen new countries in Q2. As always, I'll wrap with the progress we're seeing across partnerships. Retailers are increasingly looking to Google to support their AI transformation. This quarter, Kingfisher, Target, and Wayfair closed significant multi-year cloud and ads deals. Combined with the implementation of UCP, these partnerships will help deliver personalized, AI-driven agentic experiences from discovery to checkout. In closing, I'd like to thank Googlers everywhere for their contributions to our success, and as always, our customers and partners for their continued trust. Anat, over to you.
Thank you, Philip. My comments will focus on year-over-year comparisons for the first quarter, unless I state otherwise. I will start with results at the Alphabet level and will then cover our segment results. I'll end with some commentary on our outlook for the second quarter and full year 2026. We had an outstanding first quarter, delivering our 11th consecutive quarter of double-digit revenue growth. Consolidated revenue reached $109.9 billion, up 22%, or 19% in constant currency. Total cost of revenue was $41.3 billion, up 14%. Tech was $15.2 billion, up 11%. Other cost of revenues was $26 billion, up 15%, primarily driven by increases in depreciation, content acquisition costs largely for YouTube, and compensation. Total operating expenses were up 24%, to $28.9 billion. R&D expenses increased by 26%, driven by compensation due to investment in AI talent, as well as depreciation. Sales and marketing expenses were up 23%, driven primarily by marketing investments to support the Gemini app and search, as well as compensation. And G&A expenses increased 21%, primarily due to an increase in compensation costs related to legal and other matters. Operating income increased 30% to $39.7 billion, and operating margin was 36.1%. Other income and expenses was $37.7 billion, representing a meaningful increase from the prior year, primarily due to unrealized gains in our non-marketable equity securities portfolio. Net income increased 81% to $62.6 billion, and earnings per share increased 82% to $5.11. We generated operating cash flow of $45.8 billion in the first quarter and $174.4 billion for the trailing 12 months. CapEx was $35.7 billion in the first quarter, with the overwhelming majority of this spend in technical infrastructure to support the AI opportunities we see across the company. Approximately 60% of our investment in technical infrastructure this quarter was in servers, and 40% was in data centers and networking equipment. Free cash flow was $10.1 billion in the first quarter and $64.4 billion for the trailing 12 months. We ended the quarter with $126.8 billion in cash and marketable securities and $77.5 billion in long-term debt. And as we announced today, our board of directors declared a 5% increase in the quarterly dividend. Turning to segment results, Google Services revenues increased 16% to $89.6 billion, reflecting strong growth in search and subscriptions. Google Services revenues also benefited from a strong FX tailwind. Google Search and other advertising revenues increased by 19% to $60.4 billion, driven by growth in the retail and financial services verticals. YouTube advertising revenues increased 11% to $9.9 billion, driven by direct response advertising as well as brand. Network advertising revenues of $7 billion were down 4%. Subscription platforms and devices revenues increased 19% this quarter to $12.4 billion due to strong growth in both YouTube subscriptions, particularly in YouTube Music and Premium, and Google One subscriptions, which benefited from increased demand for AI plans. Google Services operating income increased 24% to $40.6 billion, and operating margin was 45.3%. The Google Cloud segment delivered outstanding results in the first quarter. Cloud revenues accelerated across all key areas and were up 63% to $20 billion. Revenue growth was driven by strong performance in GCP, which continued to grow at a rate that was much higher than Cloud's overall revenue growth rate. The largest contributor to Cloud's growth this quarter was AI solutions, driven by strong demand for industry-leading models, including Gemini 3. In addition, we had strong growth in AI infrastructure due to continued deployment of TPUs and GPUs, and core GCP continues to be a sizable contributor, driven by demand for infrastructure and other services such as cybersecurity and data analytics. Workspace again delivers strong double-digit revenue growth, driven by an increase in the number of seats and the average revenue per seat. Cloud operating income was $6.6 billion, tripling year over year, and operating margin increased from 17.8% in the first quarter of last year to 32.9%. Google Cloud's backlog nearly doubled sequentially, reaching $462 billion at the end of the first quarter. The increase was driven by strong demand for enterprise AI offerings and the inclusion of TPU hardware sales that Sundar referenced earlier. The majority of the backlog is related to typical GCP contracts, and we expect to recognize just over 50% of the backlog as revenue over the next 24 months. In other bets, revenues were $411 million, and operating loss was $2.1 billion. For the past few years, we have been working to prioritize our efforts and investments in the other bets. In Q1 of this year, Verily completed an external capital raise that resulted in its deconsolidation from Alphabet. G-Fiber announced plans to combine with Astound Broadband, which will result in its deconsolidation from Alphabet when the deal closes, which we expect to take place in Q4. And we continue to allocate significant resources to businesses where we see meaningful opportunities to create value, such as Waymo. Turning to our outlook, I would like to provide some commentary on factors that will impact our business performance in the second quarter and full year 2026. First, in terms of revenues, we're pleased with the overall momentum of the business. At current spot rates, we would expect to see an FX tailwind of approximately 1 percentage point to our consolidated revenue in Q2, compared to a 3 percentage points FX tailwinds in the first quarter. In Google Cloud, as Sundar mentioned, we will begin to deliver TPU hardware to a select group of customers in their own data centers. We expect to begin recognizing a small percent of the revenues from these agreements later this year, with the vast majority of revenues to be realized in 2027. It is important to keep in mind that revenues from TPU hardware sales will fluctuate from quarter to quarter, depending on when TPUs are shipped to customers. And finally, we're excited to welcome the Wiz team to Google Cloud with the closing of the acquisition in March, and are very pleased with the performance to date. A couple of items to highlight related to the acquisition. First, Wiz will be reported in the Google Cloud segment. And second, we expect a low single-digit percentage point headwind to Cloud's operating margin for the remainder of 2026 related to the acquisition. Moving to investment, we are updating our full year 2026 CapEx guidance range to $180 to $190 billion, up from our previous estimate of 175 to 185 billion to now include investment related to the acquisition of Intersect, which closed in March. We are seeing unprecedented internal and external demand for AI compute resources. The investments we are making in AI is delivering strong growth, as evidenced by the record revenue and backlog growth in Google Cloud and strong performance in Google Services. Looking ahead, these strong results reinforce our conviction to invest the capital required to continue to capture the AI opportunity. And as a result, we expect our 2027 CapEx to significantly increase compared to 2026. In terms of expenses, as we've discussed previously, the significant increase in our investment in technical infrastructure will continue to put pressure on the P&L in the form of higher depreciation expense and related data center operations costs such as energy. We also expect to continue hiring in key investment areas such as AI and cloud, and are investing in marketing to support our AI products. To conclude, Q1 was an outstanding quarter for Alphabet, and our teams continue to execute with high level of discipline and velocity, delivering amazing innovation. We look forward to sharing more in the coming weeks at I/O, Google Marketing Live, and Brandcast. I want to take this opportunity to thank our employees for their contributions to our performance. Sundar, Philip, and I will now take your questions.
Thank you. As a reminder, to ask a question, you will need to press star one on your telephone. To prevent any background noise, we ask that you please mute your line once your question has been stated. Your first question comes from Brian Nowak with Morgan Stanley. Your line is now open.
Thanks for taking my questions. I have two. The first one, Sundar, on a recent podcast, you talked about how you were acutely constraining that compute, something you focused on almost every week to sort of make sure you're deploying capacity correctly. So let me ask you this: as you sort of look at the search business, what are the areas that you are most excited about applying next generation compute toward to sort of generate an ROIC on that return in search in the next 12 months? And then the second one is on the sale of the TPUs to third parties. Just can you help us philosophically understand the strategy around pricing them, given the high ROIC of using TPUs to power multi-year Google Cloud workloads a little bit? Thanks.
Thanks, Brian. I'll take the search one first. Obviously, you've seen we are taking advantage of all our investments in building the Gemini models, and both obviously applying it in search and the Gemini app, driving innovations in AI overviews and AI mode, and they're all contributing to the increased usage of the product. I do think looking ahead across both these surfaces, there is a massive opportunity to go deeper in what we do for our users. I think bringing agentic workflows to consumers in a way that it's easy for them to do, including in the context of search, I see as a huge opportunity ahead. And obviously, we are in very, very early innings of all that. And but our investments in our full stack of AI approach, I think, puts us in a good position to bring those experiences to search, and I'm pretty excited about it. On the second question around TPUs, obviously, we do think about it as, what are we doing through Google Cloud to help our customers? And, that's the framework with which we think about it. In that context, there are situations where it makes sense. For example, you take customers like capital markets, where they're running this, highly performant, AI workloads. They wanted, TPUs in their data centers. So there are, and those trends are true across a diverse set of industries, and in certain cases, frontier AI labs too. And so we are, opportunistic about it. But I do think we step back and think about it overall as the opportunity for Google Cloud. A lot of it is providing infrastructure through cloud. At times, it is direct sales of TPU hardwares to a select group of customers. But again, we do take ROIC approach. And some of it helps us get more economies of scale, scale in our overall compute environment as well. And so helps us invest in the cutting edge, which we need to do the next generation as well.
Thanks, Sundar.
Your next question comes from Doug Anmuth with JP Morgan. Your line is now open.
Thanks so much for taking the question. One for Anat and one for Philip. Anat, you talked about 2027 CapEx, that it'll increase significantly, and I know you didn't quantify, but how do you think about the current CapEx trajectory's ability to service this massive backlog that you've built up in just the last quarter and what will no doubt increase going forward? And then, Philip, can you just talk more about the drivers of search queries at an all-time high, and then how you're thinking about how much room there may be to increase coverage of search queries, just ability to show ads against a higher percentage of queries than the 20% you've been at historically? Thanks.
Thanks, Doug, for the question. Let me start with your first question on the CapEx and how we think about CapEx increase going into 2027. So you've seen us over the past several years increase CapEx every year, and we have done it very thoughtfully to meet the demand that we are seeing both from external customers as well as demands across the organization. And you're seeing the proof point, the ROIC on that in terms of just the growth rate we're seeing, whether it's growth rate within search or certainly the cloud business and the opportunity we have within the cloud backlog. So as we're seeing that robust demand across the business, we are looking at what can we do to support that growing demand and the opportunity ahead of us. And increasing CapEx to meet that demand will provide more clarity in future earnings call about what that number will be. But that's the opportunity we're seeing ahead of us. It's quite meaningful, and we want to make sure we capitalize that and we do it in a way that's responsible as we've done to date.
So on the second part of your question, first of all, just to zoom out for a second, I mean, we're very pleased with the performance of our ads business here. And as Anat shared, Google services benefited from a strong FX tailwind. That's important to keep in mind. The strength we saw in search was not due to a single driver, but was really the result of many parts of our business showing strength and working very well together. If I just deep dive for a second into the vertical perspective, retail, finance, I talked about it, and health drove the greatest contribution. Although all major verticals actually contributed, and we make hundreds of changes every quarter to improve the user experience, the advertiser experience, and so that's really contributing to our performance here. And we've also been able to generate very strong ads performance while significantly involving the search results page here. The queries continue to grow, and as Sundar mentioned, they were at an all-time high. We see AI overviews and AI mode continue to drive greater search usage and growth in overall queries, including in commercial queries. You specifically ask about the 20% on the coverage side. And as I said before, I think with the ability of AI to better understand intent and a lot of other vectors around it, I think there is upside in that coverage number. And overall, just the understanding that we have with Gemini on intent has just significantly expanded our ability to deliver ads on longer, more complex searches that were previously really difficult to monetize. And I shared earlier, we're deploying our Gemini models now across all of our ads infrastructure, and it's really driving improvements across the big three areas that I highlighted in my prepared remarks.
Thank you both.
Our next question comes from Eric Sheridan with Goldman Sachs. Your line is now open.
Thanks so much for taking the questions. Maybe two, if I could. The first one, just building on the answer so far, when you look at the backlog you disclosed today, Sundar, I would love to know if you can come back to your comments on AI infrastructure and your unique approach and how that positions you to either build capacity, scale compute, and do it in a way that is, as Anat said, sort of effective from a margin standpoint as well as a compute standpoint, just to understand where you sit competitively in your mind relative to others. That'd be one. And then, Philip, to bring you into the conversation, you referenced UCP, and there's been a lot of industry inertia around UCP very quickly. Talk to us a little bit about what UCP means for this services business as agentic commerce scales in the years ahead. Thanks so much.
Thanks, Eric. Look, I do think I do think we are genuinely differentiated. We are unique in the market because of our vertically optimized AI stack and the way we co-develop the components from our infrastructure and models to platforms and the tools to applications and agents. And the fact that we own frontier models, own the silicon, really helps us stay ahead of the curve. And on top of it all, just to put an extra point on it, the deep investment in our security layers to keep everything safe. And I think we are the only provider in the market that offers all of these in a vertical stack. And so so overall, again, to my earlier comments to Brian, I think about it all as Google Cloud. We have many different ways to serve our customers, so we can meet them in a way suited to their needs. I think better than other players here. And I do think, looking ahead, our ability to invest in this moment and stay at the frontier, I think puts us in a strong position. And I think we are doing it based on tangible demand signals we are seeing. And it's not just on the revenue side, but I'm talking from a ROIC framework. And that's what is helping us navigate this moment responsibly.
And to the second part of your question, look, I mean, we're in the early stages of the agentic era. Agentic is more than just completing transactions. We all know this. We see agentic experiences as additive, and it will really transform how we shop from discovery to decisions, while helping, obviously, brands differentiate themselves. We've been very intentional about creating an agentic experience that works for our users, our partners, for the entire ecosystem. And our goal is really to remove the grunt work of shopping so consumers can focus on the enjoyable parts. For decades, you could either shop fast or smart. And I think with agentic commerce, you no longer have to actually choose between speed and certainty here. And the vision is to make commercial experiences across the board assistive, more personal, more fluid. And we're carefully designing space and agentic workflows for users to really see valuable components of their shopping journey beyond just price, such as customer service, brand loyalty, and more, while removing the friction of the process that I just talked about. And this is exactly where the part of your question kicks in, the Universal Commerce Protocol, a new open standard for agentic commerce that works actually across the entire shopping journey, from the discovery to the buying and the post-purchase support that we just talked about. And it was really co-developed with the industry leaders, including, I mentioned them, Shopify, Etsy, Walmart, and so on. And we've received tremendous feedback so far from hundreds of top tech companies, payments partners, retailers, really interested in integrating. And it will help power a new checkout experience in AI mode, in search, in the Gemini app, and allowing shoppers to actually check out from select merchants right as they're researching on Google and going through this journey. So we're very, very excited about it.
Our next question comes from Ross Sandler with Barclays. Your line is now open.
Yeah, just following up on the last question on agentic shopping. So it seems like we're at the point in time where this is actually going to start happening finally. So Philip, just to elaborate a little bit, as you look at carrying the AdWords business from kind of the old way of doing things to this new agentic frictionless shopping way, how do you see the price and volume kind of growth trends for core AdWords evolving as you start implementing more agentic workflows in search?
Look, our number one focus is obviously on the user experience here. And I think the most important part in this is what I mentioned before. We're carefully designing the space in the agentic workflows for the users to actually see the valuable components within that shopping journey. And the second you have the space, you obviously have the ability for interesting advertising models. I think it's also worthwhile noting that beyond just the traditional agents, there's a lot of additional ways we can actually use AI to improve the shopping experience. And you can think about it like our apparel try-on tools that is now available in the US. You can think about Google Lens. So there's a lot more to do here. But I think the key part is actually what I said before. We focus on the user experience here, and then I think all else will follow if we pay attention to the points I mentioned.
Your next question comes from Michael Nathanson with MoffettNathanson. Your line is now open.
Thanks. One for Sundar, one for Philip.
Sundar, if I can connect Brian's question, Eric's question, and go a little bit higher, I wanted to understand how are you deciding, how are you allocating which divisions and projects get excess capacity given that you're constrained, right? So how do you decide between all the internal projects you have and the external projects, right? So what types of screens are you running to decide, who gets the incremental capacity? And then for Philip, I've noticed, and you said this on the Gemini app, there's more and more images that come to you in the shopping journey. Can you talk about your thoughts about adding advertising on that app and what's guiding your decision making here on adding ads on Gemini? Thanks.
Thanks, Michael. I think great question, and on an ongoing basis, I'm looking forward to Gemini helping me more and more as I'm thinking that through. Look, I do think that the foundation where we start with it is what do we need from a R&D standpoint to develop models at the frontier. So what do you need for training these models, and so effectively the compute needed for GDM, because it's a foundation for everything we do, and so that's a core principle with which we operate. And then obviously, we with the ability to plan ahead, we do long range plans on our core areas, be it search, be it YouTube, and so on, as well as what we see in Google Cloud. And obviously in Google Cloud, we are providing enterprise AI solutions, which this quarter, had a 800% year-on-year increase from the prior year. So we are seeing strong demand for Gemini Enterprise, our AI solutions there. We see strong demand for infrastructure in Google Cloud. And as I said earlier, in select cases, we are seeing demand for TPU hardware in others data centers as well. So we are modeling these out and working to allocate across these areas. Obviously, we are compute constrained in the near term, and as an example, our cloud revenue would have been higher if we were able to meet the demand. So we are working through that moment, and we are investing, but we have a robust long-range planning framework, and we see extraordinary opportunities ahead, and we are allocating with that framework in mind.
And to the second part of your question, as I said in my previous answer, we are obviously focused on the user first and creating a really great user experience with all of our product, especially our newer products. And specifically on monetization in the Gemini app, our focus right now is on AI mode. But it's fair to say that we really believe a format that works well in AI mode would transfer successfully to Gemini app. And so today in the Gemini app, we're focused on the free tier and subscriptions, and our AI plans were a sizable contributor to our Google One revenue growth. But let's also be clear, ads have always been a big part of scaling products to reach billions of people. And if done well, ads can be really valuable and really helpful commercial information. And at the right moment, we'll share any plans, as we have said, but we're not rushing anything here.
Thank you, guys.
Your next question comes from Mark Shmulik with AllianceBernstein. Your line is now open.
Yes, thanks for taking the question. Philip, one more on search performance, if I can. You talked a few times about kind of optimizing for the consumer experience. And I guess besides higher query volume, is it fair to conclude that consumers are using these AI tools, Google's or otherwise, and it's shrinking their purchasing journeys, converting at higher rates? And if so, is there a way to dimensionalize how much of the strength in search is being driven by that behavioral change against perhaps some of the newer advertiser AI tools that you've been launching and rolling out? Thank you.
I think the way to think about it is really to think about the expansionary moment we see here for search. This is the key part. AI is fundamentally changing how the world searches for and how it accesses information. Queries are at an all-time high. Sundar said this. Traditional search really started with 10 blue links, and now we have AI overviews in AI mode, and they have made search more intelligent than ever, and they let you ask far more complex questions. And we have Lens or Circle to Search, or we have Search Live. Search Live is now available to all countries and languages that support AI mode. Again, shows you the expansionary nature of it. And we have our AI-driven search campaigns, and we have now SMBs that can reach customers at a scale that it really wasn't possible even a few years ago. And you can add in Google Translate and so on. So I feel if you factor all of this in, we're in a pretty good place and are quite excited about where this is going.
Your next question comes from Ron Josey with Citi. Your line is now open.
Great, thanks for taking the question. Maybe this one is for Anat. We continue with margins continue to expand here. I wanted to understand maybe if you could break down the cost drivers or really the drivers of margin expansion, particularly amongst cloud. There's a thesis out there that AI revenues are a lower margin in general, but we are seeing margins improve. So more insights on just the cloud business and what's driving that margin expansion. Obviously demand, maybe pricing, but that would be helpful. Thank you.
Sure. Let me help unpack the margin expansion. Obviously, we're pleased to see that there are pushes and pulls across the business, including within cloud specifically. And I would start with the top line. When we see this robust, strong revenue growth, both in cloud and Google services, it does provide leverage all the way down to the bottom line within the income statement. And we've been working hard to ensure we're running a productive and efficient organization. And it's not just how we operate the business, but even in areas such as our technical infrastructure, where we are investing these significant CapEx investments in our data centers and servers, we are looking at how we drive scientific process innovation within that organization. And that is reflected both in cloud and Google services as we allocate cost based on consumption. In the past, I did talk about the depreciation associated with these investments that is hitting both Google Cloud and Google services. Google Cloud expanded margin quite significantly from a year ago, as you've seen in our numbers that we've just previewed. And a lot of it is the top line growth that Google Cloud is providing or producing, as well as an incredibly efficient way of running the business. I will give Thomas and the team a lot of credit for running a very productive organization and making sure that we are supporting our customers and providing the services and products that they want and benefit from, continue to drive top line growth, and doing this well within the middle of the income statement, all the way from a very efficient technical infrastructure, thinking through how do we leverage AI across our business. Sundar mentioned the use of coding internally, or how Gemini helps us there optimizing our real estate footprint. And we're going to continue to do this. We're not going to stop here. We're going to continue to push for more efficiency, knowing that we're going to have the headwind associated with the depreciation coming with higher CapEx level.
Thank you. Very helpful.
Our next question comes from Ken Gorowski with Wells Fargo. Your line is now open.
Thank you very much. Two, if I may, please. First, on the cloud and capacity, could you speak about how your verticalized capabilities enable you to navigate a complicated supply chain, especially one experiencing inflation and constraints? Are you factoring any supply chain price inflation into 26 and 27 CapEx commentary? And as part of that, maybe not, could you update us on the allocation of compute capacity, internal versus external cloud? And then one more, please. When you think about search query volume growth, we're clearly seeing expanding use cases. Historically, it's always been free to the consumer with and completely ad supported. Do you see future use cases where certain consumer use cases are more effectively monetized via subscriptions, and maybe a different mix of the consumer quote unquote search, the new search opportunity? Thank you.
All right, Ken. Maybe there are a few parts to it. Maybe I'll touch on it. And on overall compute, I think I spoke earlier on how we think about allocation of compute across our businesses. And I think again, the long range planning and the ROIC frameworks give us a good way to plan ahead. I do think obviously we are, working through a complicated supply chain environment, as you point out, and we are factoring that into any commentary we give. But I think the scale at which we are operating and our ability to work across all layers, both, our supply chain partners see the strength of our diversified businesses and the demand we drive, and our frontier technology and the investments all through the stack. I think they help us get into deeper partnerships all across the supply chain, and I think that's and I mentioned earlier the economies of scale point as well. So all of that factors in a positive way there, I think. In terms of search, look, I think we are proud that we build models at all. We are at the frontier across the Pareto frontier. We do think about capability and the cost frontier deeply, so that we can serve users at scale. But at the same time, we can bring in the most powerful models for the most demanding queries. But the future, as you are right, that in a valuable as we serve more and more valuable use cases, there are going to be use cases where people will want to use the most powerful model, and there may be different ways to accomplish that. So we're going to put the user first and support them in the way they want to use the product, and we are already provide various tiers of our subscription plans, in which you can get access to more powerful models, and that applies across your Google user experience, and including in search. And you've seen the momentum. We saw a very robust quarter in terms of our AI subscriptions growth. Driven by interest in getting access to better Gemini models, and so I think that sets us up well to serve the breadth of use cases people would want in all places, including in search.
Thank you.
And our last question comes from Justin Post with Bank of America. Your line is now open.
Great. Thank you for taking my question. I expect a lot of interest in your TPU sales. So can you help us think about how you're thinking about the opportunity there, and then maybe how much break down the backlog growth a little bit between TPUs and cloud? And then second question, just think about the margins on these big generative AI cloud deals. How do you think about these $100 billion deals coming in and the margins associated with those? Can they be similar to your cloud business as it is? Thank you.
Look, overall, I would say, look, we see tremendous interest in there's tremendous demand for both AI solutions as well as AI infrastructure, including massive interest in our GPU offerings as well as TPUs, and so we are proud that we can provide customers with a very diverse with the breadth of our offerings, and let them we can meet them in terms of where their needs are. And maybe I'll pass it to Anat to give some color on the backlog growth.
Yep. So the backlog, the TPU hardware agreements that Sundar referenced in his prepared remarks are reflected in our cloud backlog of the $462 billion. Although the majority of the backlog is still GCP agreements. Now, as you think about the total backlog, just over half of it will convert to revenue in the next 24 months. And the TPU hardware sales, more specifically, we expect a small percent of them to see coming through as revenue later this year, and then the majority to be realized as revenue in 2027.
And then anything on the big AI deal margins with the generative AI companies?
Look, I think nothing to comment on any specific contracts, but overall, earlier there was a lot of questions about how do we allocate. And remember, in a constrained environment, when we are choosing to allocate across all these opportunities, we are working off a robust ROIC framework.
Thank you.
Thank you. And that concludes our question and answer session for today. I'd like to turn the conference back over to Jim Friedland for any further remarks.
Thanks, everyone, for joining.
Okay, that is the Googs. Street likes it. 375 after hours. Meta should be starting in a second. Any quick thoughts from you guys on Google?
Few constrained and they increased capex. They mentioned for 2027 is going to be meaningful higher. So I thought that was crazy for them to tell us that on Q1 of 2026 that 2027 capex was going to be higher than 2026. I think it's a big win for AI investors.
Yeah, the train's not slowing here. It's pretty freaking incredible, actually. Like, Google's so well positioned in advertising, artificial intelligence. If they want to move ads into Gemini, they can. Like, they just have a ton of flexibility. So, yeah, they're very well positioned. But now, hopefully, literally, Meta and Google are the exact same price, but one's negative and one's positive. They're both either up or down 6.74%. Like, they're tied right now, but on the opposite sides. So hopefully Meta can turn around on their call. But yeah.
Their call's at right now?
Right now.
Okay.
All right, here's Meta.
The Meta Platforms first quarter 2026 earnings conference call. Joining me today to discuss our results are Mark Zuckerberg, CEO, and Susan Li, CFO. Our remarks today will include forward-looking statements, which are based on assumptions as of today. Actual results may differ materially as a result of various factors, including those set forth in today's earnings press release and in our annual report on Form 10-K filed with the SEC. We undertake no obligation to update any forward-looking statement. During this call, we will present both GAAP and certain non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in today's earnings press release. The earnings press release and an accompanying investor presentation are available on our website at investor.appmeta.com. And now I'd like to turn the call over to Mark.
All right. Hey, everyone. Thanks for joining today. We had a strong quarter for our community, our business, and our progress towards AI. More than 3.5 billion people use at least one of our apps every day. We saw a small decrease in total family dailies due to internet outages in Iran and blocks in Russia, but otherwise trends across our apps are strong. Daily and monthly actives on Instagram and Facebook continue to grow, with video driving all-time high engagement across both apps. WhatsApp continues to see strong momentum too, including in the US. And Threads continues on its trajectory to be the leading app in its category. Our biggest milestone so far this year has been the release of our Muse family of models and our first model, Muse Spark, along with a significantly upgraded new version of Meta AI. This was the first release from Meta Superintelligence Labs, and it shows that our work is on track to build a leading lab. Over the past 10 months, we have built the strongest research team in the industry and established the scientific and technical foundations to scale very advanced models. Spark is just one step on that scaling ladder, and we are already training even more advanced models. But Spark has already made Meta AI a world-class assistant that leads in several areas related to our vision of personal superintelligence, including visual understanding, health, shopping, social content, local, creating games, and more. We're hearing very positive feedback on it so far. We've seen large increases in Meta AI use since releasing the updates, and the Meta AI app has consistently been near the top of the app stores as well. Now that we have a strong model, we can develop more novel products as well. Since I first wrote about our vision for personal superintelligence last year, we've been focused on delivering personal and business agents to billions of people around the world. Our goal is not just to deliver Meta AI as an assistant, but to deliver agents that can understand your goals and then work day and night to help you achieve them. My view of AI is very different from many others in the industry. I hear a lot of people out there talk about how AI is going to replace people. Instead, I think that AI is going to amplify people's ability to do what you want, whether that's to improve your health, your learning, your relationships, your ability to achieve your personal career goals, and more. My view is that human progress has always been driven by people pursuing their individual aspirations, and I believe that this will continue to be true in the future. People will be more important in the future, not less. Meta believes in empowering individuals, and those are the kinds of products that we're going to build, and I believe that they're going to be some of the most important and valuable products of all time. We are building a personal agent focused on helping people achieve the diverse goals in their lives. We were also building a business agent focused on helping entrepreneurs and businesses across the world use our tools and others to grow their efforts, reach new customers, and serve existing customers better. These agents will work together to form an ecosystem. And whether you use our personal or business agents to achieve your goals, I believe that the future will see a massive increase in entrepreneurship from people creating new things that they've always wanted to exist, but previously didn't have the tools to bring into the world. We're already testing an early version of business AIs, and weekly conversations have grown 10x since the start of this year. We're also working on using Spark in our upcoming models to improve our recommendation systems and core business in Facebook, Instagram, and ads. Right now, our apps primarily help people accomplish 3 important goals: connecting with people, learning about the world, and entertainment. But we've always wanted our apps to understand more of people's goals so we can help improve their lives in all of the ways that they want. These new AI models will let us understand this in more detail. So instead of just looking at statistical patterns of what types of people engage with what content, for the first time in Meta's history, we're going to be able to develop a first principles understanding of what you care about and what each piece of content in our system is about, so that way we can show you more useful things for what you're trying to accomplish. And we'll also be able to create personalized content specifically for people to help you achieve your goals as well. Since our recommendation systems are operating at such large scale, we'll phase in this new research and technology over time. But the trend over the last few years seems clear, that we are seeing an increasing return on the amount that we can improve engagement for people and value for advertisers. This encourages us to continue investing heavily in what we expect will provide increasing value over the coming years as well. On that note, we are increasing our infrastructure CapEx forecast for this year. Most of that is due to higher component costs, particularly memory pricing. But every sign that we're seeing in our own work and across the industry gives us confidence in this investment. That said, we are very focused on increasing the efficiency of our investments. And as part of that, we are rolling out more than 1 gigawatt of our own custom silicon that we're developing with Broadcom, as well as significant amount of AMD chips to complement the new NVIDIA systems that we're rolling out as well. One of the primary goals of our Meta Compute initiative is to lead the industry in efficiency of building compute, and we expect that will be a strategic advantage over time. Talking about building physical goods at scale, our AI glasses continue to perform well with the number of people using them daily tripling year over year. This continues to be one of the fastest growing categories of consumer electronics ever. We released Ray-Ban Meta Optics this quarter, designed for all-day wear rather than primarily as sunglasses. And building on our release of Oakley last year, we have some exciting new partnerships and styles that I think are going to have the potential to reach even more people coming later this year. All of our glasses are designed to easily update to use our newest AI models and features. I'm also really excited to see the glasses evolve from being able to answer questions to being able to be a personal agent that's with you all day long, helping you remember things and achieve your goals. Beyond glasses, I am excited for more of our metaverse efforts to be powered by the AI models we're training as well. We remain the biggest investors in the VR space across the industry, but we are focused on making our VR business sustainable as we invest more in other areas like AI and glasses. Before wrapping, I want to talk for a moment about how AI is transforming our work. We are seeing more and more examples where 1 or 2 people are building something in a week that would have previously taken dozens of people months. And I want to make sure that Meta is the best place in the world for these types of people to come and make an impact. We're building the next evolution of our company around these people. And there's a lot that we can do to enable this. Building the best infrastructure for creating and delivering products at scale, streamlining our teams so they aren't bigger than they need to be, recognizing and rewarding the people who are having outsized impacts, and setting ourselves up to try many more ideas and take on many new projects in the future. Of course, we will continue pushing to increase our efficiency as well, But overall, I think the future is about building many more higher quality things than we've ever built before. All right, that is what I wanted to cover today. We are living through a historic technological transformation. We are among the few companies positioned to shape the future, and we are on track to do that. I'm looking forward to delivering personal superintelligence to billions of people. And as always, I am grateful for the hard work of our teams and to all of you for being on this journey with us.
Thanks, Mark, and good afternoon, everyone. Let's begin with our segment results. All comparisons are on a year-over-year basis unless otherwise noted. We estimate 3.56 billion people used at least one of our family of apps on a daily basis in March, which declined slightly from December due to internet disruptions in Iran and a restriction on access to WhatsApp in Russia. Absent these impacts, growth in family daily active people would have been positive quarter over quarter. Q1 total family of apps revenue was $55.9 billion, up 33% year over year. Q1 family of apps ad revenue was $55 billion, up 33% or 29% on a constant currency basis. In Q1, the total number of ad impressions served across our services increased 19%. Impression growth was healthy across all regions, driven primarily by growth in engagement and users, as well as ad load optimizations. The global average price per ad increased 12% year over year in Q1, with broad-based growth as we benefited from ad performance improvements, better macro conditions versus Q1 of last year, and currency tailwinds in international regions. This was partially offset by strong impression growth, including from lower monetizing regions. Family of apps other revenue was $885 million, up 74%, driven primarily by WhatsApp paid messaging and subscriptions revenue. Within our Reality Labs segment, Q1 revenue was $402 million, down 2% year over year due to lower Quest headset sales, which were partially offset by continued strong growth in AI glasses revenue. Moving now to our consolidated results. Q1 total revenue was $56.3 billion, up 33% or 29% on a constant currency basis. Q1 total expenses were $33.4 billion, up 35% compared to last year. Year-over-year growth was driven mainly by infrastructure costs and employee compensation. The growth in infrastructure costs was due to higher depreciation, data center operating costs, and third-party cloud spend. The growth in employee compensation was driven by technical hires we've added over the past year, particularly AI talent. We ended Q1 with over 77,900 employees, down 1% from Q4, as the impact of headcount optimization efforts in certain functions was partially offset by hiring in priority areas of monetization and infrastructure. First quarter operating income was $22.9 billion, representing a 41% operating margin. Q1 interest and other income was negative $1.1 billion, driven by unrealized losses on our equity investments. Our tax rate for the quarter was negative 23%, which was favorably impacted by a tax benefit of $8.03 billion. This benefit partially relieves the $15.93 billion non-cash tax charge we recorded in the third quarter of 2025, which reflects updated guidance from the U.S. Treasury issued in February 2026 regarding the tax treatment of previously capitalized R&D expenditures in the United States. Absent the tax benefit, our Q1 tax rate would have been 14%. Net income was $26.8 billion, or $10.44 per share. Absent the tax benefit, our net income and EPS would have been $18.7 billion and $7.31, respectively. Capital expenditures, including principal payments on finance leases, were $19.8 billion, driven by investments in servers, data centers, and network infrastructure. Free cash flow was $12.4 billion. We ended the quarter with $81.2 billion in cash and marketable securities and $58.7 billion in debt. Turning now to the business performance. There are two primary factors that drive our revenue performance: our ability to deliver engaging experiences for our community and our effectiveness at monetizing that engagement over time. On the first, we're continuing to see significant gains from our content recommendation initiatives. On Instagram, the ranking improvements that we made in Q1 drove a 10% lift in Reels time spent. On Facebook, total video time increased more than 8% globally in Q1, the largest quarter-over-quarter gain in 4 years. Within the US and Canada, ranking improvements we made drove a 9% increase in video watch time on Facebook in Q1. These gains are benefiting from advances we're making across the full stack. Starting with data, we doubled the length of user interaction sequences we use for training on Instagram in Q1 and increased the richness of how each user interaction is described, enabling our systems to develop a deeper understanding of user interests. Within our models, we've significantly increased the speed with which our ranking models index new posts, which is enabling us to recommend them sooner after they are published. We're also applying more advanced content understanding techniques, which is enabling us to quickly identify posts that may be interesting to someone, even if they haven't engaged with a lot of similar content. These and other improvements have enabled us to increase the diversity and recency of recommended content, with same-day posts now representing more than 30% of recommended Reels on both Instagram and Facebook, more than double the levels 1 year ago. We're also using AI to unlock more inventory by auto-translating and dubbing videos into a viewer's local language, enabling us to recommend a more diverse set of content. Over 500 million users on each of Facebook and Instagram are now watching AI-translated videos weekly. Looking forward, we're making several investments we expect will deliver more valuable recommendations. This year, we will continue scaling up our models in several dimensions, including their size and complexity, while incorporating LLMs to deepen content understanding across our platform. This will enable us to better match people to a wider variety of content aligned to their interests. At the same time, we are executing on our longer-term efforts to develop the next generation of our recommendation systems. This includes building foundation models that power organic content and ads recommendations, as well as developing LLM-based recommender systems. Our focus this year is validating the model architectures and techniques in these domains before we scale them out in future years. Aside from our recommendations work, we are focused on deploying the models from Meta Superintelligence Labs to enable a new set of product experiences. We're seeing encouraging results within Meta AI since we began powering responses with the first model from MSL, MuseSpark. In tests we ran leading up to the launch, we saw meaningful engagement gains that accelerated week over week with each new iteration of the model. We're seeing similar gains within Meta AI following the broad rollout of our new model, with double-digit % increases in Meta AI sessions per user. MuseSpark is now powering Meta AI in direct chat threads across our family of apps, as well as the standalone Meta AI app and website, giving billions of people globally access to our latest model. Overall, we're very encouraged by the momentum within our research and product roadmap, and look forward to sharing more detail on what we're building over the course of the year. Turning to the second driver of our revenue performance, increasing monetization efficiency. The first part of this work is optimizing the level of ads within organic engagement. Here we continue to enhance our systems to show ads at the optimal time and location. In Q1, we also expanded availability of ads on our newer surfaces, including bringing ads on threads to people in more markets. On WhatsApp, we're making good progress with the rollout of ads in status, with hundreds of millions of people now viewing them daily. Moving to the second part of increasing monetization efficiency, improving performance for the businesses who use our services. To do so, we're deploying AI more deeply across each layer of our systems and tools. Within our ad systems, we're delivering performance gains as we deploy more complex and predictive models. In Q1, enhancements we made to Lattice's modeling and learning techniques, along with advances in our GEM model architecture, drove a more than 6% increase in conversion rate for landing page view ads. In addition, we've been investing in more performant inference models for when we're serving ads. In the second half of last year, we began rolling out our new adaptive ranking model, which is an LLM scale ads recommender model that we use for inference. This model improves our inference ROI by routing requests to more compute-intensive inference models when it determines there is a higher probability of conversion. In Q1, we expanded coverage of our adaptive ranking model to support offsite conversions, which drove a 1.6% increase in conversion rates across the major surfaces on Facebook and Instagram. We're also leveraging AI to make it easier for businesses to manage their customers, develop ad creative, and engage with customers. The Meta AI Business Assistant has now been fully rolled out to all eligible advertisers on supported Meta buying surfaces, providing personalized recommendations to advertisers, resolving account issues, and surfacing campaign insights to help optimize results. Performance has been strong since we began testing the assistant in Q4, with common account issues being resolved at a 20% higher rate. This week, we're also introducing Meta Ads AI connectors in open beta, providing advertisers the ability to connect their Meta ad account directly to an AI agent. We've always supported advertisers both on our platform and through tools like the Marketing API. And now we're extending that to AI so businesses and agencies can analyze and optimize campaigns with the tools they're already using. Usage of our ad creative tools is also scaling, with more than 8 million advertisers using at least one of our GenAI ad creative tools, and particularly strong adoption among small and medium-sized advertisers. These tools are benefiting performance as well, with advertisers using our video generation feature seeing more than 3% higher conversion rates in tests. We're also seeing good traction in using AI to facilitate customer engagement. In Q1, we expanded business AIs on WhatsApp to SMBs across Latin America and Indonesia, as well as on Messenger in Asia Pacific. We now have more than 10 million conversations each week being facilitated through business AIs, up from 1 million at the start of the year. We'll further expand access to more countries this quarter while adding more capabilities to the AIs. We also continue to invest in the value optimization suite, which helps advertisers maximize their return on ad spend by prioritizing the highest value conversions, rather than optimizing solely for the most conversions at the lowest cost. Adoption by businesses has been strong following performance improvements we've made over the past year, with the annual revenue run rate of our value optimization suite now over $20 billion, more than doubling year over year. Last, I want to touch on our commerce efforts. People discover products on our platforms through ads and organic posts, with brands increasingly turning to creators to promote their products. This is contributing to rapid growth in our partnerships ads product, with its revenue run rate more than doubling year over year in Q1 to $10 billion. To support the product discovery and purchasing happening through creators, we're expanding our solutions beyond ads. Last month, we rolled out our affiliate partnerships offering on Facebook to more test partners so creators can tag products from participating retailers on their posts and earn a commission when someone makes a purchase. We have also started testing similar experiences on Instagram. We see a real opportunity to help people more easily discover and buy products within our services, particularly as we incorporate AI deeply across our platforms. Next, I would like to discuss our approach to capital allocation. Compute is becoming increasingly important as it determines the quality of services we can provide, including powering more capable models and delivering innovative new products. It is also becoming more critical to how we work at Meta, as we are entering a world where employees are managing agents to help them generate new ideas, run experiments, execute tasks, and build products. We are investing aggressively to meet our infrastructure needs and ensure we maximize our strategic flexibility over the coming years. This includes substantially expanding our own data center footprint and striking deals throughout the supply chain to secure necessary components for future capacity. We're also signing cloud deals that will come online over the course of this year and 2027, allowing us to scale more quickly. These multi-year cloud deals and our infrastructure purchase agreements drove a $107 billion step up in our contractual commitments this quarter. Our investments will support our training needs for future models and, most importantly, provide us the inference capacity necessary to deliver personal and business agents to billions of people around the world, along with several other AI product experiences we're developing. As we grow our infrastructure spend, we remain committed to operating efficiently, and we recently shared internally that we plan to reduce the size of our employee base in May. We believe a leaner operating model will allow us to move more quickly while also helping to offset the substantial investments we're making. Moving to our financial outlook, we expect second quarter 2026 total revenue to be in the range of $58 to $61 billion. Our guidance assumes foreign currency is an approximately 2% tailwind to year-over-year total revenue growth based on current exchange rates. Turning to the expense and CapEx outlooks, we expect full year 2026 total expenses to be in the range of $162 to $169 billion, unchanged from our prior outlook. We continue to expect to deliver operating income this year that is above 2025 operating income. We anticipate 2026 capital expenditures, including principal payments on finance leases, to be in the range of $125 to $145 billion, increased from our prior range of $115 to $135 billion. This reflects our expectations for higher component pricing this year and, to a lesser extent, additional data center costs to support future year capacity. Absent any changes to our tax landscape, we expect our tax rate for the remaining quarters of 2026 to be between 13% and 16%. Finally, we continue to monitor active legal and regulatory matters, including headwinds in the EU and the US that could significantly impact our business and financial results. For example, we continue to see scrutiny on youth-related issues and have additional trials scheduled for this year in the US, which may ultimately result in a material loss. In closing, Q1 was a solid start to the year with strong execution across our core ads and engagement initiatives. We're also making exciting progress on our AI research and product efforts and expect to build that momentum over the course of this year. With that, Krista, let's open up the call for questions.
Thank you. We will now open the lines for a question and answer session. To ask a question, please press *1 on your touch-tone phone. To withdraw your question, again, press *1. Please limit yourself to one question. Please pick up your handset before asking your question to ensure clarity. If you are streaming today's call, please mute your computer speakers. And your first question comes from Brian Nowak with Morgan Stanley. Please go ahead.
Thanks for taking my question. Mark, I wanted to ask you just about the level of investment you're making and sort of the signposts you're watching to ensure you're going to generate ROIC on all these investments behind Muse and the other products. So if you could just sort of let us know some of the key factors you're watching over the next 12 to 24 months, whether it's Meta AI, Muse advances, core algorithm. What are you sort of watching for most just to make sure that you're on the right path to generating healthy ROIC on all this CapEx and infrastructure spend?
That's a very technical question for, basically where the things that we're watching are to make sure that we're on track building leading models and leading products. The formula for our company has always been build experiences that can get to billions of people and focus on monetizing them once you get to scale. I think we're seeing a little bit of that here, where basically we invest in advance to build leading models, then we convert that into leading products, and then we think that these are going to be some of the most important products that get built over the next decade. So I think just like anything else that we've done over time, the basic milestones that I look at are around, first, technically, are we delivering the quality to enable a great product? Then second, when you have the product, how is it scaling? And then third, you look at the monetization and then you drive up the efficiency of it towards increasing profitability. I don't think we have a very a precise plan for exactly how each product is going to scale month over month or anything like that. But I think we have a sense of the shape of where these things need to be. And I think if you look at the usage of these and the quality of the products and the quality of the models that are out there and the use that other frontier models are getting and the trajectory of that, I'm quite comfortable that the lab that we're building is on track to be a leading lab in the world. I think Muse Spark was a very high quality model. It powers Meta AI, which I think is now a world-class assistant. We have an ability to be able to grow that and have a large amount of engagement. And over the coming quarters, we're just going to be tracking how do our next set of training runs go, how do our products scale, how excited are we about the products in the pipeline, where right now we're very excited. And then we'll also ramp up monetization over that period of time as well. So I think that those are the set of things that I look at. I think for the kind of specific financial questions, I think Susan can jump in if there's anything more to add.
Your next question comes from the line of Mark Shmulik with Bernstein. Please go ahead.
Yes, thanks for taking the questions. Mark, I guess now that we've got Muse Spark kind of out there launched, how are you thinking about the team's focus here, kind of divided onto further model training runs and kind of further specialization and that personal intelligence goal, versus product launches and kind of shipping more product out the door? And Susan, I guess kind of as a follow-up to Brian's question, I know it's too early to discuss 2027 CapEx, but we've had peers mention tonight a potential significant step up. Any way to think about dimensionalizing kind of how we think about some of the returns or traction this year and how it might affect 2027 spend? Thanks.
I mean, I think the roadmap from the team has been pretty consistent. So we have the research team, which is focused on scaling increasingly intelligent models with capabilities for the specific things that we're focused on, which are business and personal agents. So we just released our first model, and I talked about in my comments how we're climbing this scaling ladder towards greater capabilities and scale for the models. That work continues. We have our next set of more advanced models in training now, and that is that work will, I think, just continue. I mean, that's a loop. I don't think we're going to be done with that anytime soon. We're going to have teams that are just consistently focused on training more intelligent and more capable models in the ways that we want. Then we have our product team, and that team is now really unlocked to be able to build things on top of our models because we now have very strong models. So before this, we had been prototyping a bunch of things using other different models, whether it was our previous older models or kind of using the APIs from other companies. And now we're unlocked to be able to go build things and get them to scale on top of our own models. So I think you will see that over some period of time. I tried in my opening remarks to give a bit of a sense of where we're going, but I think that more of the details of that will become clear over the coming months. And I think that these are just both loops that we'll iterate on. We'll keep on iterating on the intelligence. We'll keep on working on building new products and scaling the products. And then as we get to product market fit, we're also going to increasingly focus on building the businesses around them and decreasing the costs. And this is kind of how we've done everything over the last 20 years of running the company. And that is basically the plan.
Mark, on your second question, we aren't providing a specific outlook for 2027 CapEx. And we are frankly undergoing a very dynamic planning process ourselves as we're working through what our capacity needs will be over the coming years. Our experience so far has been that we have continued to underestimate our compute needs, even as we have been ramping capacity significantly. As the advances in AI have continued and our teams continue to identify compelling new projects and initiatives, and now too there are very compelling internal use cases. So our expectation is that compute will become even more central to the business going forward, and it will be critical to determining the quality of the models we develop, the types of products we can introduce, how productive we can be as an organization. So we're going to continue building out our infrastructure with flexibility in mind, And if we end up not needing as much as we anticipate, we can choose to bring it online more slowly or reduce our spending in future years as we grow into the capacity that we're building now.
Your next question comes from the line of Eric Sheridan with Goldman Sachs. Please go ahead.
Thanks so much for taking the question. Maybe if I can build out on one of the topics that was discussed in the prepared remarks, but just the opportunity set that sits in front of the company with respect to putting agentic compute in front of both consumers and enterprises. You've long been associated with sort of the consumer landscape, and I am curious about how you're thinking about extensions of the media engagement parts of your business model and the commerce parts of the business model to become more agentic over time. But what do you see also as the opportunity set that sits in front of you across SMBs and enterprises where historically you maybe haven't had as much product velocity? Thanks so much.
Hello?
Thanks, Eric. So I would say, in the near term, obviously the sort of biggest focuses are
They
some
heard
of
you,
the
Tanner.
mentioned around deepening sort of engagement, obviously with our existing community and user base, making ad experiences meaningfully more personalized, more engaging, more valuable, helping SMBs find and engage with customers across our platform. Those are some of the, I think, most intuitive and adjacent opportunities to the business that we have today. And then, of course, as we are able to build out more agentic capabilities, enabling agents to help people be more productive, but also agents for businesses, and enabling, frankly, those agents to interact with each other and build what we hope will be a thriving commerce ecosystem on our platform. So, I would say some of these are a little bit further out, especially in that latter category of things. Again, the focus is on building personal super intelligence, building a consumer agent that can work for you and help you get things done. That right now is a consumer experience that we're focused on, but we think there will be clear monetization opportunities over time. You can imagine commission structures or a premium offering. And on the business side, we're seeing a large opportunity, of course, around agents and scaling our business AI initiatives. I think I mentioned earlier in my remarks that there are over 10 million weekly conversations between people and business AIs on our messaging platforms. That's up from 1 million at the start of the year, and we're going to continue expanding globally in Q2. And business AIs today are currently free for most businesses on our messaging apps. But as we make more progress, we expect that we will also work towards establishing a longer-term monetization model, and we'll also consider other services that we can offer to businesses in the future. But we don't have anything more to share today.
Your next question comes from the line of Youssef Squali with Truist Securities. Please go ahead.
Great. Thank you very much for taking the questions. Maybe one for Mark and one for Susan. Mark, Ray-Ban Oakley AI glasses continue to perform really well for you guys, but EssilorLuxottica owns and manages a lot more brands. What are the gating factors to see the launch of additional glasses under these other brands this year, and what would be a successful year for you as you look back at 2026, maybe in terms of units sold? And then Susan, on that 10% RIF, how much of that is due to efficiencies for maybe AI implementation versus just the need to stay fit? And as you look at your employee needs over time, how do you see that growing maybe relative to your overall top line growth? Thank you very much.
I can go ahead and take both of those. I might answer your second question first. And I'm just trying to make sure I got all of the parts of the question. So in terms of what these sort of, kind of the optimal size of the company, I think over time, we don't really know what the optimal size of the company will be in the future. I think there's a lot of change right now with AI capabilities advancing rapidly. We're very focused on leveraging AI tools to substantially increase our productivity, and we're seeing that reflected in the accelerating output from our engineers. And we're generally approaching this with a bias toward wanting to use these tools to build even more products and services than we would have before. At the same time, we're making very significant investments in infrastructure, and we are very focused on continuing to operate efficiently. So I think we will be continuously evaluating how we're structured just to make sure we're best set up to deliver against our priorities over the coming years. So that is, I think, your second question. The first question was about the AI glasses. We have, we're continuing to see strong growth in obviously the AI glasses sales over the course of Q1. Demand for the expanded portfolio lineup has generally been quite strong, and we're seeing sales shift now from the prior generation of Ray-Ban Metas to the latest generation, which I think speaks to the value of the improved features like extended battery life and higher, features like higher resolution video, higher resolution video capture. Sorry. So we're, pretty excited about, the progress we've made with glasses. We see strong interest now in the Meta Ray-Ban displays with the Meta Neural Band. So that's an encouraging sign that there's consumer appetite for display glasses, which is kind of the next generation of how this product evolves. And yeah, so I think this is an area that we will continue to be excited about and are investing in.
Your next question comes from the line of Justin Post with Bank of America. Please go ahead.
Great. Thanks for taking my question. Mark, it took about 10 months to get Muse Spark out. I think it's a pretty good pace. Just to help us understand what kind of unlock that is for some of the new products you're developing, and how's the product cadence going to be over the next 9 months on either consumer or business enterprise products built on top of that model?
I mean, the field is moving pretty quickly. So, I mean, I'm very happy that I think the lab that has gone the fastest from standing up the lab to having a very kind of widely accepted as strong model. So I think that's good. I take that as a very significant validation of the effort, that the team is working well together, that the infrastructure is working, that the effort is on track. I think that's basically the main thing that we've learned over the last quarter that I would take away is like where we started what is this pretty big bet, and it's on track for our plan. In terms of what exactly the cadence is going to be, it's tough for me to say, both because I don't really want to share competitively sensitive information and because I think some of the stuff we are more focused on quality than hitting a specific date. I mean, on the research side, this is research, right? We are trying novel things. You don't exactly know when they're going to land. And on the product side, I think we care a lot about just having, let me put it this way. There's a lot of agents out there, right, that people are building for different things. And there aren't that many that I would want to give to my mother. And I think getting to like that quality bar is something that I care about more than hitting a specific week for launching or something like that. So, but with that said, we're in a zone here where the teams don't check in with me like once a quarter. We make meaningful progress like day over day. I think that's part of the fun of developing in this world is that people can make very rapid progress. Small groups of people and teams can make very rapid progress. So I think we're going to see a lot of innovation. The timing of this call is it's good in some ways because the Muse Spark release I think was positive. The Meta AI first release I think is positive. I think that shows that we're on track. I'm trying to kind of paint a picture of the very high level direction that we're going in, but I think that the picture is going to come into focus a lot more over the subsequent quarters.
Your next question comes from the line of Ross Sandler with Barclays. Please go ahead.
Yeah, Mark, just sort of related to that last answer, but there's a lot of new consumer applications kind of cropping up, everything from like an OpenClaw to something a little bit more consumer friendly that you would build for your mom, like you said, with like Poke or Dreamer, which you recently acquired. So how are these new ideas, I guess, changing your view around the direction that core Meta AI or Dreamer or kind of your overall agentic strategy needs to go? And then the second part of it would be, do you think the lab will stay in this consumer lane, or do you think you need or you want to go down the route that others are going down with code writing and like the recursive self-improvement loop and in that direction, kind of in parallel. Just thoughts on that. Thank you.
Yeah. So look on the OpenClaw and other agents, I think that they give you a very exciting glimpse of what types of things should be possible. Now, they're pretty rough systems today, and to set up OpenClaw, you need to like install a computer locally and then get into a terminal and like configure a bunch of things that, again, like there's maybe there's hundreds of thousands of people or small numbers of millions of people who could do that. But what we're talking about is delivering personal superintelligence for billions of people around the world. So how do you make a version of that experience that is a lot more polished and dialed and easy, and that has all the infrastructure basically done for people already, and that just works? And that's kind of what we're focused on the consumer side. And I'm really excited about that. I think if you had something like that worked quite a bit better than those systems and was easy enough that people could just get, then I think you go from having something that hundreds of thousands or millions of people are going to use to something that is going to be addressable to billions of people. And that has been our primary focus from day one of the lab, is being able to deliver something like that as a product. And I think it's just going to be very exciting. By the way, the same thing is true for businesses, right? I mean, there's the personal version of this, but there's also, a lot of people's goals are they want to create things, right? They want to create websites, they want to create products, they want to grow their products. These are all things that good agents are going to be able to help people do, which I think is partially why this is so exciting. And, in my opening comments, I talked about how today we can handle a few goals for people. They're big goals, right? We can help people stay connected with people they care about, learn about the world. These are big things that people care about, but they're not the only things that people care about. And one of the things that I would love for our products to be able to do is just understand people's goals specifically, and then be able to just go work on them for them, and check back in and whenever you have questions that you need answered. So whether those are personal goals, or you're trying to create a business or do work, I think that this is stuff that I think literally every person in the world is going to want some version of it. And also, I think it is something that scales, where the more you want to get out of it, I think people are going to also be willing to pay a lot of money to have premium or high compute versions of it. So I think that this is it's a very exciting area. But I think what you all should be waiting to see is whether we can build the version that really just works, and how effective we are at converting people who are using our products into being hundreds of millions and then billions of people using this stuff. And then over time, how can we effectively convert that into something that's increasingly profitable by monetizing it and getting the cost down? So I think that's the roadmap of what we need to do. You asked about whether we're primarily focused on consumers or also recursive self-improvement. I think that we've talked about two main goals for the team. I mean, one is this kind of agents vision of what we're doing. The other is that self-improvement is really important, because you can't build a leading AI product if you don't have leading models. So, and you're not going to have leading models in the future if your models can't improve themselves, right? It's you're getting to a point where today the models are still able to learn from people, and then I think at some point the models will have to improve themselves, and that's how the growth is going to, an improvement in the models is going to happen. And if we don't have an ability to do that, then we or anyone else, I think that the companies that don't do that are not going to be leading labs, and then they're not going to produce leading products. So I think that is a table stakes thing that we are focused on. Now, does that make us a developer tools company? Not necessarily. I mean, I'm not against having an API or coding tools or anything like that, but it's not our primary focus. But I actually think people conflate coding with self-improvement more than they should. Coding is one ingredient for the model self-improving. It's not the only thing. And we are focused on all of the parts that are going to be necessary for self-improvement in service of the personal superintelligence vision that we have for people and businesses.
Your next question comes from the line of Ron Josey with Citigroup. Please go ahead.
Great. Thanks for taking the question. Mark, maybe a quick follow-up to a prior question around personal agents and business agents. And with Spark News now live and more models in development, do you look at the personal agent opportunity, which we talked about earlier on in the call, more of a short-term, medium-term, long-term goal? I'm sure it's a never-ending goal, but when we see a product, is the question short or medium-term? And then, Susan, I think the ranking recommendation model improvements are very impressive to see given the size and scale of both Instagram and Facebook. Could you help us understand just how doubling the length of user interaction sequences can drive greater usage? There's a thesis out there that maybe some of the ranking recommendation improvements are along the two. So it seems as if there's a lot more room to go. So any help there would be helpful. Thank you.
I mean, I think that the agents work, there's going to be short-term versions of it, but then I think that there's going to be massive upside for delivering more intelligence and more capabilities in the models. And you're kind of seeing this across the industry. Each, month, each generation of models, they just have more capabilities and can do more things, and people absorb it, and are able to get more superpowers, and it's awesome. It's like the most exciting time in the industry. So I think of the agents as the product vehicle for delivering that capability to people, and we certainly, I think this year is going to be a key period for establishing that as the vehicle for how people are going to use this. But then the model improvement, I think, is going to be something that's going to go on for a very long time. So there's a lot to do here in both the short, medium, and long term.
And then on your second question, which I think is about the ranking and recommendations improvements that we talked about in our that I talked about in my earlier remarks. I think first of all, there is still a lot of room to continue improving recommendations over the rest of the year, and we expect we'll be able to do that to drive additional engagement on both Facebook and Instagram. A couple of the things. First, we're going to continue to improve our data infrastructure. That's going to allow our models to train on more data, and we're adding more detail to how we describe the content that users have engaged with in the past, and scaling up the complexity of our model architecture to take advantage of those larger data sets, like using even longer histories of content interactions. And that should all be in service of improving the overall quality of recommendations. We also are focused on making the recommendations even more personalized and more relevant to any given user's interests. There's work we're doing to redesign our content retrieval system to show more content that matches the full range of a user's interests, and to tailor the diversity of the topics we recommend to the broadness of someone's interests. So someone with particularly concentrated interests might see relatively more of that content, while people with a broader set of interests might see kind of a greater range in the topics that we show them. And then finally, we're continuing to make improvements to our sort of LLM-based tune your algorithm features that allow users to provide more granular natural language feedback on what they want to see more of or less of in their feed. So the sort of the sequence length, which is the thing that you called out, is one of really many improvements we made in Q1, and there is a big roadmap of further improvements going forward.
Your next question comes from the line of Doug Anmuth with JP Morgan. Please go ahead.
Thanks so much for taking the questions. Mark, how do you think about the step up as you go from leveraging smaller models in the ad business to use Spark and future large language models going forward? What are some of the key unlocks across engagement and monetization? And then on Manus, can you just talk at all about the strategic importance and the role in developing agentic products for Meta, and then just current status around the tech and the deal? Thanks.
I'll take that question. On Manus, we're still working through the details, so we don't have an update right now. On your first question, which is about sort of the going from leveraging smaller models in the ads business to the ads sort of models growing. There's already some work underway, and I think I alluded to some of this in my earlier remarks, even kind of in the current landscape of the ads roadmap, where we're basically trying to advance the architecture here to allow us to leverage the abilities of larger models. Historically, we haven't used larger model architectures like GEM for inference because their size and complexity would make them too cost prohibitive. And the way we drive performance from those models is by using them to transfer knowledge to smaller, more lightweight models that are used at runtime. The inference models are bound by strict latency requirements since they need to find the right ad within milliseconds, and that has, again, historically prevented us from meaningfully scaling up their size and complexity. But in the second half of last year, we introduced a new adaptive ranking model, which enables us to leverage LLM scale model complexity of 1 trillion parameters, and we made advances in the model architecture and co-designed the system with the underlying silicon so it maintains the sub-second speed that is required to serve ads at scale. We also developed an approach that intelligently routes requests more compute-intensive inference models if it determines that there is a higher probability of conversion, and that lets us drive both better performance and increase inference ROI. So there's a lot of work being done there before we even sort of incorporate more of the LLM work into our underlying ads ranking models.
We have time for one more question. Ken Gorelski with Wells Fargo, your line is open.
Thank you very much. Two, if I may. First, if I could, you talked on the Muse Spark launch, you talked about two categories or two verticals. You talked about health and wellness and shopping. Could I dive a little bit, ask you to dive a little deeper into the latter on the shopping and commerce side? And maybe if you could, were there any learnings in the 2021-22 phase where you pushed deeper into commerce on Instagram and on Facebook? Any learnings from that period that you might apply? Is there an opportunity for a next gen marketplace type business in commerce? And then the second, please, maybe Susan, could you talk a little bit about, based on your model improvements and the content recommendations, how much visibility do you think you have to kind of the growth trajectory on the core business? You continue to grow at basically double the pace of the industry, despite being a very large share of the industry. Could you just talk about a little bit about your visibility into that continued performance? Thank you.
Yeah, so I might give you a somewhat loftier answer to the question. You're asking about shopping. I think it's sort of an interesting example of the way in which the work that we're doing is different than what I think others are doing out there. These products, AI agents get better when you fully optimize the stack. That's why we believe that we need to be a company that builds frontier models in addition to building the agents. And then in order to do that, you of course need to build your infrastructure in order to be able to do that well. So we're undertaking this large investment to be able to do that top to bottom. And I think a lot of the way to think about the investment that we're making is a bet that the individual things that people care about and that people are going to be more important in the future. And that's sort of like I think it should be a pretty obvious thing to say, but I think so much of the rhetoric around AI in the industry is around like a company trying to build some kind of centralized thing that like does all the productive work in society in some way or something like that. And that just is very different from how we see the world. Like our vision for the future is one where society makes progress by individuals pursuing their own aspirations. And some people care about big, grand things like curing diseases, and a lot of people care about personal things like finding the right shirt for my daughter. And I just think that we're going to build things that help deliver this vision for personal agents for people. And I think that part of the lane and what is interesting and differentiated about what we're doing is that that's just so different from how I hear everyone else talking about the work that we're doing. So even though I think some of these ideas, they seem like they should be so obvious, I I actually think that our approach of trying to empower individuals and building consumer things is just in the details extremely different from what others are doing. And shopping might be one kind of specific example that I think is going to have interesting commercial implications, and I think people, consumers are going to like it. But I don't hear any other labs out there talking about how they're building an AI that's really good at shopping. And I think that the reason for that is like not that shopping is the most important thing by itself, but because like empowering people to do the things that matter in their lives, whether that's local or understanding social context, or shopping, or personal health things, or understanding what's going on around them visually, which is going to be really important on the glasses. These are all elements of the personal superintelligence vision. I think like a lot of this, and when you're thinking about kind of the investment in Meta over time, I think you should think about it as coming down to these set of values around what do we want AI to do in society. And if what you want it to do is empower individuals and build a world where the AI is in service to individuals' goals, then that is what we are going to build. And I think it's going to be incredibly valuable.
Gosh, I almost wish we could end on that answer, but I will answer the second question, which I think kind of has two versions. One is, a version of like, what's the revenue outlook? And obviously we gave, the Q2 guide, which embeds, I think, both a range of kind of macro outcomes, but also the work that we've, the ongoing work that we have to continue improving both the sort of usage and engagement on our family of apps, and then our ability to continue making the ads better and more performant. I think the second question is maybe more of the second version of that question is more of a higher level question about kind of the overall trajectory of the roadmap here. And one of the things I will say, having been working on this for a very long time, is I'm always really impressed by the team's ability to continue to advance this state of the art here. And our planning process now is, I think, really fine-tuned around this. So I've mentioned on a couple calls the budgeting process, in which we run a very sort of ROI-based process to make sure that we are funding all of the ads initiatives that we think will drive growth in future years. And that's something that is both quite dialed in. And I think that, our ability to measure the impact of that has been pretty robust. And it's, been a very important driver of our ads revenue growth. And that continues to be a process that, again, we ran in this past budget. And as far as we can, as we have line of sight, we feel good about the investment opportunities ahead of us.
Great. Thank you, everyone, for joining us today. We look forward to speaking with you again soon.
This concludes today's conference call. Thank you for.
The real takeaway is that they never need to, never put all four of these Mag 7 names on at the same day, because that sucked.
Yeah, look, obviously, guys, I know people wanted Amazon, but everyone picked Meta in the beginning. I understand the stock didn't move. If the stock was up, people would have never wanted to switch the call. So
yeah, hard to switch midway through.
Yeah, I asked all these guys in the private chat, and we all agreed like a lot of people would be upset if we just switched because one stock was up versus it wasn't. So obviously we'll analyze all those companies together, but I understand it wasn't the most entertaining because the stock wasn't up. But, what do you do? At the end of the day, 25% of you wanted Amazon, 45% of you guys wanted Meta, so we kind of have to go with Meta. Regardless, a lot more than 45% of people own Amazon here, and this one has broken out, 5%. So we got a lot to talk about, a lot to get into. Sam,
let's go.
I'm sure you've been keeping up with Amazon. What's happening here?
Yeah, I have been totally keeping. I'm using Perplexity to watch the live transcript, and I'm not really paying 100% attention to the transcript that's going through, but I'm looking at the price action jump up like that. I'm like, hold on, what happened in the transcript over here? And then some of their comments, and as far as the custom silicone that they're producing with Marvell technology, which is also up 2% today, or after hours, is that they said that if the custom silicone business was a separate business, then it would be a $50 billion run rate. Like, that's freaking insane, because that's a very high margin business for them. On top of that, they made some other commentary, but I think that's around the time when the stock basically started flipping. And dude, this thing was down like 5%. Now it's up almost 5%. Like that's an insane freaking move. What is that? What is the market cap?
245 to 275.
That's almost a $500 billion move after hours. And then Microsoft basically went green for being down like 5%. Like, dude, freaking, and the Qs are at an all-time high. They're at an all-time high right now.
It's all AI infrastructure. AMD's moving after hours, CoreWeave, Nebius. Like, it's just all about the chip plays, the data center plays. That's where people are realizing the money. And Google showed off TPUs are going to be sold to external customers. Trainium's doing well. NVIDIA is going to do well. And there's going to be a whole list of companies that'll benefit from, memory to photonics to, custom silicon with Broadcom, and just a matter of how long that this lasts. And I'll defer to Jose for that. But
I don't know that, but I mean, what we heard is at least 2027, right? I mean, if CapEx, at least from Google, they mentioned they're increasing CapEx in 2027. Things are looking good. What I did thought was interesting, I was kind of looking at the Microsoft numbers. I think they mentioned that CapEx for calendar year was going to be $190 billion. And about of $190 billion, $25 billion was due to increase in component cost. I'm going to guess that is memory. But it's crazy how memory is such a heavy portion of CapEx alone. Just the price increases of memory itself. And I don't know. I do think eventually some of these big tech players are going to get angry with what they're paying for on memory.
Neil, before we get into Meta, your thoughts on some of the price action? Google, obviously the best performer. Amazon, close second. Microsoft, actually a hell of a rebound. Microsoft still red, but it was at 409 and it came back after somewhat good. I honestly don't know why it came back. Like,
their guidance for next quarter was
the guidance wasn't a big beat. It was a beat by like 25 million. It wasn't some massive beat.
But I think the beat was on the cloud side. Cloud side was expected to be 37, and they actually projected around 40+% on cloud guidance for next quarter.
Okay, so there you go. Cloud beat. Neil, your thoughts?
Yeah, I mean, I don't know, the call from Meta, because we see the price action, and of course we're happy with all the rest. But from Meta, I don't know. I mean, still an amazing business, but this call, did they say something? Yeah, didn't really provide that much extra color that we were waiting for. On the Amazon thing, Sam, you said that the 50 billion, the 50 billion figure actually isn't new. I think they mentioned this a couple of weeks ago during one of their events, I think. So it's just them reiterating that their chip business, if it was a standalone business, it would have been, of course, an amazing business.
The other reason I think Amazon started pumping, quite frankly, because again, as Neil said, Amazon didn't say anything new. Like, I mean, outside of the AWS guidance, I think it was really this. Anthropic in talks with investors to raise funds at a $900 billion valuation. The reason I say that is because another stock that was up after hours by 4%, good old Zoom, which has zero tailwinds going for it outside of their $50 million stake 3 years ago in Anthropic.
Well, I'm pretty sure Google has quite a large stake as well, something like 14%.
So that probably pumped Google. I mean, that Anthropic news, because we all knew they were probably worth more than 380 billion, but if they just more than double their valuation, I mean, Amazon stake just got a lot heavier. Same with Zoom, same with Workhouse, same with Google, all that.
Speaking of stake.
Okay, Tanner, your thoughts on Meta? What'd you think? Why do you think this one is the only one that couldn't catch a bid?
Well, because I don't think they're in the hardware space. They're not going to benefit from external clients sell. Like, I really think the other three names that they're being compared against are three of the largest data center providers: Azure, Google Cloud, AWS. That's where the market is rotating to. They're just realizing the margin's super high. It's not cyclical. This is recurring business. It's a gold mine right now. And Meta's not there. They are the largest customer of those data centers. I think they're going to do fine. The growth that they're putting up is insane. 30+%. But obviously, whenever Mark Zuckerberg starts talking about the metaverse and starts talking about the glasses, no one wants to hear it. It's not in vogue right now. It's AI or get out. And even that, sorry, can I add one thing? The whole Muse Spark thing, they're not even trying to be a frontier model the same way Anthropic and ChatGPT are in terms of charging tokens and being like extremely competitive there. It's more like an internal tool, maybe Meta AI. It just doesn't feel the same. And so they don't feel like they're going to be, one of the hyper labs like the way ChatGPT or Anthropic is.
But I think that kind of makes sense. I mean, for me, it makes sense, right? That they shouldn't be the AI lab. They shouldn't be trying to sell those tokens, but it's a way to, I know people hate it, but if he wants to talk about, if his future is the AR glasses, kind of having a model that's niche for that would be crucial. And kind of with the advertisement, instead of paying for like other tokens, if you can kind of internalize, make it your own self and just kind of like how these big tech players are creating an ASIC solution and chip, kind of think of the way I see this Muse model is like a ASIC model for its niche. And if you're kind of creating your own model, you'll be able to kind of get better rewards in the long term of things without paying some of those token margins.
Yeah, I'm not anti that at all. I just think the premium is going to the customers that are able to get extremely high margins. I'm sure Meta, like, honestly, I do believe in them long term. But right now, if you're not catching like the absolute fastest names right now, investors are just freaking out.
Yeah, it's really all about semiconductors right now, hyperscalers, data center, like anything to do with expanding on hardware. It's so heavy weighted toward that. That's why when you saw that OpenAI news with missing the revenue, like the market was highly impacted by it. And there's just not enough market cap when it comes to these software stocks and the other places to bring the market up or hold it up. So it's a little bit scary, but can't really worry too much about a big collapse if things are just getting, I don't think it's euphoric yet, but I think it's getting there.
Qualcomm and Nokia were up after hours. I mean, to your point, Sam, you're just getting anything in the hardware space, infrastructure space. Bloom Energy is almost 300.
That's crazy.
I mean, maybe this doesn't stop, right? Like, if it doesn't stop, then, is this the next few months of the market, which is SanDisk is going to 2,000, Micron's going to 1,000, right? Like if Micron gets to $1 trillion, let's say tomorrow, which would still put their forward PE at like 15, which wouldn't even be that crazy. Do we think it can stay at $1 trillion for a long time? Right? Because I think most people would say no. Even the hyper bulls would say, well, eventually it's not going to be at $1 trillion. Most people will say, no, Google will be more than 4 trillion because there's a business model that's recurring, it's growing, it's constant, it's not cyclical, all that stuff. So it's almost like some of these names that are getting the bid, they're getting the bid for now or maybe for a couple years from now. But eventually, if that bid disappears, when does the market front run selling the bid they inevitably gave them because they were so excited to bet on their future? And I don't think we know what the answer to. But then you have a Nebius, which has a vision of becoming like a hyperscaler themselves to an extent, right? Like or an actual cloud, not just a neo cloud. So I think there's a lot of different versions of how these names are thinking of the story.
Yeah. SoFi got a mention on the Amazon call, by the way.
Notos with Kramer. Do we want to watch that?
I don't care.
That's how you know how bad it is. No one wants to even watch it.
No, but if it's just obviously I'm going to listen to it on my own time. I don't want to be the 20% vote and then we're all sitting here. I've been streaming for 10 hours today. What I really want to do is go walk my dog. That's what I want to do. I want to step away from this computer right now.
I get it.
Your dog's got to take a piss, dude.
No, I mean, that's fine. Yeah.
The dog is I the portfolio.
All right, so AMD, Intel, Nokia, Qualcomm getting the derivative pump, Microsoft flat, Google, Amazon big pump. and then Meta's the laggard. I think my thoughts are I think this dip is really stupid for Meta. The call sucked. Zucks is being way too cocky on these calls every time, answering like he has better things to do, which he probably does. But also,
he's probably vibe coding.
I mean, like, but also, like, we all invest our money, you know, like it would be nice for 90 minutes for him to just act like he cares. You can just tell he doesn't get it. I mean, they were whispering, like, do you want to take that question? Do you want, like, he doesn't want to be there. I get it. But
I think he's also a bit more excited now that Muse Spark is actually a good model. Because Llama 4 sucked. Sucked really bad. Muse Spark is now already up there, and to the point you Tanner and Jose talked about before. Look, Meta doesn't need to sell the tokens because they're already profitable as you know what, as if the others they have no choice because otherwise they go bankrupt. At the end of the day, Meta, when they figure whatever super intelligence out, why wouldn't they sell you a small subscription through Instagram with their billions of users, or WhatsApp with their billions of users, like a small fee, and you have an AI agent working for you 24/7. Poof, $1 billion business.
You would agree that even if Meta never figured out super intelligence, the ads business itself, because just like Google, that deserves to be worth $2.5 trillion right now.
And e-commerce that they talked about as well, because e-commerce is going to be huge for them.
Right. Like, to me, it's absolutely ridiculous to see it down like this, and then see other names that, again, are just getting up because they're benefiting from Meta's capex. But the core business and the way that it's compounding, just like if it was Google search for so many years before this whole AI narrative, got a multiple, and it's not getting that multiple because of that narrative overhang. That narrative overhang is a real thing. And we've talked about it since January, right? That the street is so upset that Zuck is spending all this money just for ads. They need something else. And Meta Muse is more exciting. But Meta Muse is nothing like fundamentally real yet, other than it's number 4 on the App Store. But, you know, it's not inside of the products yet. So, I mean, it's a fair reason for the discount, but one could argue this thing deserves at least 25, 27 times earnings, which would put it at a 800, 850 stock right now.
It's called Muse Spark. Meta Muse sounds like a fiber supplement.
It does sound like a supplement. That's
you know, that was a Metamucil joke, and no one laughed, and that's all right. But we're tired.
We're tired.
Question for you in the chat: who goes from the green stocks, from the green names? Who goes red tomorrow? Because I don't trust this action right now because it's after hours. It's not that much volume, but do we see some flippening, or do we see some more green or red?
Tanner was so upset. He was so embarrassed.
No, someone said ban me. And too many dad jokes.
I don't know. I think if I had to bet, I think Meta sells off more tomorrow. The rest of these guys still pump. I mean, the street's so dogmatic about this. I think Meta may be below 600 tomorrow. I look, if you gun to my head, I would say it'll stay flat around 625 to 640. But could I see it dumping tomorrow? Yeah. Could I see Google pumping to freaking 380 tomorrow? Yeah. I feel like maybe the price action sticks going into tomorrow.
Yeah,
I mean, Google objectively had the best quarter, right? We can admit Google objectively.
Yeah, they dominated. This is why I like owning all the Meg 7s. Like, I won't even feel bad holding Meta on this drop. Like, this is in all, like, I don't even know what to call it. This is a fake drop. Like, what's the forward P of this company tomorrow morning? Like, under 20? Like, we're paying like 19 times forward earnings for Meta. Like, they dominated on EPS and fell while being the cheapest Mag 7 name. Like, for growing at the highest growth rate that they've seen in years and years and years. Super profitable. Like, are we just buying AI, or are we buying like quality names? Like, is there any fundamental analysis going into this? Like, are they getting replaced? Is Anthropic going to take over social media?
Dude, last quarter they were growing 16%, last quarter this year, 16%. That's 33% now on a higher base.
Yeah, like we're not going anywhere. So I'm a happy Meta shareholder. I'm a happy Microsoft, Amazon, and Google shareholder. These companies are so quality. Like, I love these names.
If Amazon gets the breakout tomorrow as well, I think Amazon 300 is going to be on the deck for a lot of people that have been screaming it. I think Amazon 300 is possible this year, but if you start breaking that 280 level, I think a lot more people start feeling it's going to happen. So yeah, tomorrow we're going to see how the street thinks of it. But overall, all the CapEx increase is bullish for everything besides the company's increase in CapEx. Eventually, hopefully, that bid goes back to the companies that are actually spending all this money.
Is Reddit impacted after hours or not?
Reddit is flat. Snapchat is flat.
Okay.
All right. That is it for us. Thank you, everybody, for being here. We'll be back tomorrow. AMD getting a bid after hours because of Intel. Trump did tweet about Intel. He said, Trump said, I'm happy I'm making Intel money. Or he said, I'm happy I'm making the United States money.
Yeah. I made a joke. I was like, when are we going to get the portfolio screenshot?
All of this is happening, by the way, with oil pumping. So, I mean,
Intel stock ticker symbol INTC.
I mean, to be honest, dude, it was a good investment.
It was. Nvidia also invested $5 billion. Yeah. So
Jensen's also quadrupled his money.
Yeah.
All right. That is it. Thank you, everybody, for being here. We'll have a lot to analyze tomorrow on all our channels. Everyone's links in the description. Appreciate everyone being here. It was a 4.5-hour stream.
Meta tomorrow, or Apple tomorrow.
Apple,
Reddit tomorrow, Tanner.
Reddit, Zeta, SanDisk. That's the one I'm going to be paying
Digital.
attention to. Yeah.
Oh, Western Digital tomorrow too?
Yeah.
Mm-hmm.
Well, there's a lot tomorrow. Okay.
So you can fade everything else. It's going to be the memory. All right.
Thank you, everybody. Appreciate it.
Alzheimer joke.
We'll see you guys tomorrow. Bye, everybody.